Halo ya? Yeah, okay. Yeah, because Wednesday I have an appointment. Yeah, memang jam 10-an. Yeah, okay. Nothing to do? Yeah, okay. Bye-bye.
Hello, if everybody could please take your seats, we'll begin shortly. Okay, so good afternoon, everyone. My name is Mark Bruni. I'll be your MC for this afternoon. It's my great pleasure and honor to welcome you all to today's event, Navigating Through Worldwide Volatility. I think today's topic is really interesting because we've had events over the last few years from the Ukraine war, which we all know about. We've had the closure and the reopening of the Chinese market and the issues they're having around demographics and manufacturing there that's spilling into Indonesia. We've got elections coming up both here and abroad next year, and especially the US election and how that plays out, and even how that could even affect the Ukraine war, and inflation. We've all seen what's happened where inflation reared its ugly head last year and we went from 0 interest rates up to 9% in some cases for mortgages. I think it's a really interesting time, not only this decade, but I think it's a really interesting time in history to be talking about this. You know, the world reopening, supply chains being broken and rebuilt, and all these things coming together really at this real focal point in time that we're experiencing now. And so today, we've brought together a group of people from various industries here who all have various opinions and experience working with volatility. And so I think today we've got two excellent partners helping us with the event today. And I'd like to thank them as well. So we've got CME Group. And so CME Group has been around for well over 100 years. Managing volatility on behalf of industry and investment professionals for well over 100 years. So I think that's an appropriate partner to have for an event like this. And so I'd like to thank Mr. Harry Yeo as well for joining us here today. Also, we've got, in addition to the CME Group, we've also, our partner is the GARP Chapter of Indonesia. And so GARP is the Global Association of Risk Professionals. And so when you're talking about navigating through worldwide volatility, having risk professionals in the room, I think, is extremely important, because managing the downside is often more important than managing the upside. You know, that's the old saying, if you lose 50%, you have to make 100% to get back to where you started. And so that's a great, it's a great segue, actually. So I'd like to introduce our first keynote speaker, Ms. Melissa Hendrawati. Melissa is currently acting as the CFO of Superbank here. Previously, she was with OI Indonesia, a payment fintech firm, focused on democratizing payments. She was formerly with DBS as head of risk and COO, and I'd like to welcome her to the stage. If we could all welcome.
I was expecting a longer opening remark from Mark Bruni, actually, right? I was like trying to sip my coffee first, but apparently his opening remark was quite brief. So, selamat siang. Good afternoon. Greetings to one and all. I hope every one of you is keeping well and healthy. Yang saya hormati, Mark Bruni, board member of CFA Society Indonesia, who has just delivered the opening remark. Allow me to also greet our honorable speaker, Mr. Wong Kon Hao of CME Group, along with Mr. Hari Yu, and Pak Tommy Chu, Director of Agrodana Futures. Also, Pak Michael Sidartawan, CRO of Aman, Pak Joseph Sudibyo, Head of Data, Science of Superbank, and Bu Melody as our panel speakers, along with Pak Aldrich as our moderator. My utmost appreciation goes to all the committee and board members of CFA Society Indonesia, CME Group, and GARP Chapter Indonesia, who have made today possible. And most importantly, a very warm welcome and thank you to all of you, all the respected guests who have come to attend this event. On behalf of CFA Society Indonesia, GARP Chapter Indonesia, and together with CME Group, we are very honored to host this conference today. So I've been like, mentioning three different entities, over and over again, because it's really a joint collaboration between the, these three societies and CME Group as well. Yeah. So let me share with you the reason behind the selection of today's topic, navigating through the worldwide volatility. I'm pretty sure everyone here agrees with me that every single day, every single hour, every single millisecond, we all experience uncertainties in our lives, or in market term, in a cool term, volatility, even so in the recent years. So the COVID-19 pandemic has caused a significant impact in the economies and the societies globally. That leads to volatility in the financial markets, disruption in the supply chain, and also shift in the consumer behavior. On top of that, I think Mark mentioned about the high inflation rate that's been persistent, the ongoing tension between Russia and Ukraine, the geopolitical conflict between the major economies such as US, China, right, have all contributed to the economic uncertainty and fluctuation in the market worldwide. While on the technology front, we have also seen volatility. We have been seeing rapid development in technology such as RPA, robotic process automation, generative AI, ChatGPT, IoT, blockchain, digital economy's trajectory. Everything here have caused disruption across the industries and in almost every business touch points. Okay. Having said all those, right, we as part of investment, finance, risk management communities here in this room shouldn't be too worried of volatility. Rather, we must be cognizant that risk and uncertainty that we are talking about today is inevitable and absolutely a part and parcel of our lives. We are exposed to different extent of risk each and every day in our lives, be it risk at the personal level or at the professional context. Just a very simple real life example. I think Mr. Wong just now mentioned, right? from airport to this hotel, it actually took 2 hours, right, yesterday, right? So, when we are rushing for, maybe you were rushing for some meeting yesterday, for example, should you choose whether to follow Google Map or should you follow the driver, right? Or your gut feel? That alone is a simple example of taking risks, right? Taking risks, simple risks, but sometimes it's making us quite annoyed, right? Amidst all the uncertainties. Just a simple example. In looking at things, it is really our choice to adopt half cup full or half cup empty kind of mentality, right? And I choose to see it with half cup full mindset most of the time. I'm a firm believer that behind huge uncertainties lies great opportunities, as long as we can take whatever happens positively and stand ready to embrace any challenges that come our way. Now, let's talk a little bit. I mean, this room is full of smart people, so I should bore you a little bit. Let's turn our attention to macro. Let's turn our attention to our beloved country, Indonesia. So Indonesia, I would say, is a land of opportunities and Southeast Asia's digital powerhouse. It is the 4th largest country by population and the largest economy by GDP in Southeast Asia. We have more than 200 million online population and 77% of internet penetration. Indonesia is predominated, I think we discussed also outside that Indonesia is predominated by digital native young population. Young population, I think I should emphasize that, of 180 million millennials and Gen Z who have become the driving force in the digital economy landscape. So we believe that young Indonesians, have been the rapid adopters of digital economy, and they are extremely receptive to digital products. They are very keen to try different digital products, right? Which is good news. Let's talk about stats. Current value of Indonesia's digital economy reached 40% of the value of digital economy in ASEAN, right? 40%, 40. Indonesia's digital economy is worth $77 billion in 2022. This is based on a very reliable stats. And this number is predicted to almost double to $130 billion by 2025. To give you some context, 130 billion is actually more than 10% of Indonesia's GDP in the digital economy, right? So it's massive opportunities. On top of that, we have seen massive growth contributed by startups as part of digital economy landscape. We have startup expert here, Mark. So you would agree that Indonesia is top 6 globally in terms of the number of startups. This is based on the stats. And we have more than 2,400 startups in Indonesia with 9 unicorn, 2 decacorn. Now, after I've been talking a lot about opportunities, right? From the macro perspective, the question to us here in this room is that, are we ready to play our best part in helping our beloved country, Indonesia, to achieve its vision, which is Indonesia Emas 2045? Are we ready? I've been talking a lot about opportunities, right? So now let's talk about challenges, because I think some risk professional here, we want to see the other side of the coin, right? Let's talk about challenges that are prevalent in Indonesia for it to reach the challenging yet attainable growth. In my opinion, there are 2 main challenges. The first challenge is the digital talent deficit. Indonesia needs 9 million digital talents to fulfill the digital economy potentials. You would agree with me, 10 years ago, there were no functions or role called data scientists. Right, Joseph? Yes, okay. I'm not forcing you to say yes, but I think 10 years ago, data scientists, CISO, Chief Information Security Officer, DPO, Data Protection Officer, those functions were non-existent 10 years ago. UI, UX designer, product designer are also not as common as now. From my own experience helping, the management of my current employer, transforming the bank from a conventional setting to a digital bank, it is really not easy to source good talents, especially in the area of technology, and also product. That being said, there's an urgent need to develop digital talents through reforming our education system, also by upskilling, reskilling our existing workforce. So it's our responsibility as the leaders in this room to think about how do we upskill, reskill our team. And this revolution in the digital talents need a multi-stakeholders collaboration between the government, the companies, all the institutions, and individuals like all of us here in this room to groom the digital talents ourselves, and also to enable more digital capabilities and change the mindset, our mindset and the people that we lead. Okay, that's the first challenge about the digital talent deficit. The second challenge, in my opinion, is the need to have the right leadership style for the right generation. If we notice what has happened around us today, there has been a generational shift in the workforce from previously mostly baby boomers and Gen X to millennials and Gen Z. Now the composition of the workforce is predominantly filled by these two generations, i.e. millennials and Gen Z. In my opinion, I'm not the expert, but I think there's a different expectation for these two generations when they are looking at leaders, right? These groups of generation, they do not expect the leader to be fearless all the time, to be brave all the time, but more of using empathy. And sometimes it's okay for leaders to be vulnerable. They require leaders to promote creativity, innovation, experimentation, but also acknowledge failure when it happens. They want to be led by leaders who prioritize building trust through personal connection, and also fostering collaboration among the team members. So this, this kind of value will create a positive, safe space and inclusive work environment that millennials and Gen Z appreciate. At the end of the day, the hope is to have empowered team as a result of having the right leadership style. So I think, it is extremely important to understand these key challenges. I mean, I just mentioned two because of limited time, around talents and leadership, because by playing our part to build an agile digital talent pool, along with exercising the right style of leadership, I am confident we together here, we can navigate through the uncertainty and the worldwide volatility with greater confidence and resilience. Remember, uncertainties present opportunities and for growth and transformation, and our ability to embrace them will determine our success together in this ever-changing world. Okay, after I bore you with opportunities, challenges, and also, what was that before that? All the stats, right? If I may, let me share a little bit about CFA Society Indonesia and GARP Indonesia chapter. I just happen to be in both society. Our vision is to be a community of Indonesian finance and risk professionals for us to network and collaborate, as well as for us to be platform for continuous development. Having said that, I think you notice that we have been hosting regular events, sharing sessions in a technical, soft skill, including best practices in finance, investment, and risk management. We do hope, sincerely hope, to create a vibrant and collaborative society which can act as the catalyst, right, to enable finance and risk professional, finance risk management area to take central role in every company's growth. So if you have been in the corporate world for quite some time, maybe some of the people in their mindset, business is the central of the company. Let's now make finance, risk management, and investment as part of the the central, the driving force of every company's growth. Okay, so we welcome you to join our future events, and we also encourage you, if you are interested. I think some of you approach me outside to, you want to sit for the prestigious certifications to advance your career. Please, we welcome you, right? the more the merrier for us, because by doing that, our community can be larger and can be more vibrant by your participation. So feel free to reach out any of us from CFA Society Indonesia or GARP Indonesia chapter if you would like to discuss or have any questions. All right, moving back to our agenda of the conference today, we will be having 3 great sessions today. I cannot wait to hear all the great speakers today. In the first session, we will be learning about the role of market psychology in influencing market trends and how to make informed decisions in volatile market by Mr. Wong. So if we have learned about behavioral finance, if you still remember in CFA, right? A lot of good theory. Now is the chance to hear practical insights directly from the expert. Okay, this will be followed by second session by Pat Tommy, another expert here, around how we overcome volatility with simple yet proven techniques. And the third session will be a panel discussion with our panelists, Pak Michael, Pak Joseph, Bu Melody here, about how credit scoring model has transformed amidst uncertainty or recent developments such as generative AI, and how the shape of the credit scoring of the future be like. I'm very excited to hear from the experts here. Last but not least, once again, thank you all for coming to this event. And most importantly, after this event or during the tea break, let's use this opportunity to network with each other and continue being a lifelong learners so that we can really fulfill the theme of today's conference, navigate through the worldwide volatility with greater resilience and full confidence. Okay, without further ado, I shall pass this back to our MC, Mark Bruni, to proceed with the next session. Thank you so much.
Great. Thank you for that, Melissa. If you can join me in just giving her another round of applause. Also, it's nice to be reminded how old I'm getting with millennials and Gen Z now filling up the workforce. And, Melissa herself is a great example of millennials taking over leadership positions now in that generational shift. And also Melissa touched on the having to develop the talent here in Indonesia as well. And I think it always strikes me back to the India technology example and where Indonesia is at the moment, where I have recollections when I was a young banker back in Sydney in the mid-noughties, and we would, there was this trend then of all of the cheap non-technical tech work was being offshored to India back then, because India was known to be cheap but not very good. And then you fast forward to today, and in the previous startups that I've been working in, we're now going to India for tech talent, to bring in the real experts. And this is, less than 20 years later. And I think with the demographics here in Indonesia, with the opportunities here in Indonesia, obviously that's something that's going to flow if it's handled right. But you can see there's the right people in the right positions now to make sure that happens. So exciting times. So without further ado, I'll introduce the first panel here today. It's the role of market psychology in influencing market trends and how to make informed decisions in a volatile market. And so to lead this panel, I think we've got the perfect candidate to lead this panel, and Mr. Wong Kon Hao. Mr. Wong, welcome to Jakarta. Thanks for coming down. Mr. Wong has started a company called Wepedia, which actually trains people in pretty much this exact topic in terms of making informed decisions in volatile markets. After all, if a market's not really volatile, there's maybe not so much opportunity as well. Mr. Wong's also he's a private investor, and sorry, I lost my cue there. So he manages his own private capital. He's here today representing CME Group, and he's had over 20 years in the markets as well. And so without further ado, I'd like to invite Mr. Wong to the stage to take this panel.
Thank you, Mark. And also want to thank you, Melissa, for the opening speech. And I just want to affirm your vision for Indonesia, that I was walking down the street at the Chillax last night. It's definite I could see that there's a long runway. Among the Asia country, there's a long runway for Indonesia development. Now, why I say so? Because back home, our minister has spoke very well about Jakarta, Indonesia. Now, he said, and most of them said that there's a lot of young professionals, many young professionals in Jakarta, in Indonesia. That makes a difference in Indonesia compared to the rest of the Asia country. Why young profession is important, not just IT, but young profession is important because I was young 30 years ago. So it means that you have a large population of young talent. It also means that Indonesia and especially Jakarta have a long runway. Just want to second your vision about Jakarta. And also talk about risk today. I'm going to share with you a lot of data point about risk, but I think for this season, the theme that I use is this. Yes, I'm going to share a lot about risk, but among the participants is this. If we know what is the risk that's lying ahead of us, we discuss about it, we acknowledge that, and we know what's the risk lying ahead of us. Are you still seeing risk ahead of us? Or are you seeing opportunity that's lying ahead of us? We're going to talk about risk, but risk management. Then where can we transform this risk to an opportunity? Now, let me just start this, my presentation formal. And first of all, I want to thank you, CFA Society Indonesia, the board member, Ms. Melissa Hedrawati, thank you, and board member, Mr. Mark Burney, and also the executive director, Mr. Rahmat Halim. Thank you for having myself and my partner, who is a CME Group, Mr. Harry Yo, that is here today. And definitely it's my honor to speak alongside with Mr. Tommy Chu and the rest of the panelists. And definitely a great pleasure to meet up with many of the distinguished guests this afternoon. Now, today we're going to talk about how to navigate through worldwide volatility. Now, many of my friends ask me about, Connor, how do you know that the risk is coming? How do you know that this opportunity is coming? Of course, when I say how do I know, I do not mean that I'm always absolute. We can never be absolute in what we're seeing. But relatively, I think we can score maybe 70% right most of the time. I think that's pretty impressive. The 30% when we're wrong, we just have to risk manage it well. Now let's go to the next slide. Next slide. Yeah, so today, a lot of my friends ask me, how do I know that the risk is coming or the opportunity is coming is this. I think I got to credit my earlier days about coming to 30 years ago, that my first career I started on the trading floor itself. Now, I was a floor trader. That's how I got started as an apprentice. And I dragged myself functioning as a floor trader on the trading floor because my personality do not fit into the environment. I'm an introvert and the environment is loud. The traders are loud. They are gung-ho. They fight to get a trade. They fight to get their trade. And 3 years, I thought I learned nothing on the trading floor. So I asked to be transferred to be as a dealer in the office. But when I was at the dealer, when I look at the prices, the buy, sell, it flashes the last done and the charts. And I have a wake-up call. So what I spent, I thought I wasted my time for 3 years on the trading floor. Everything, when I was on the screen, makes sense what had happened on the trading floor 3 years, where I dragged that journey. Now, when I look at the chart, when I look at the screen, the flashes, the buy, sell, the last done, the volume, suddenly a wake-up call that over the last 3 years on the trading floor, I've not wasted my time. I begin to understand that I could see that there's a lot of fear within the transaction, a lot of greed, a lot of confidence. When I say confidence, it could also mean insiders trading as well. Now, let me just explain how the floor trading works here. Today, when we trade the market, invest in market is through electronic, where Joseph is very familiar with. Now, it's all digitally transacted, matched. But in the past, it was floor traders. So as a human, we match trade. 1,000 at 10,000, we match trade. So within this chaos, the matching of trades, in fact, there's a lot of emotion that's go beyond within this transaction. Again, it's fear, greed, and confidence that I'm going to describe that tonight. Within all this transaction, that encompass macro development as well. So we're going to study deep about how to recognize all these. So today, as I look at the digital transaction on the screen, as I look at the chart, so my mission, or I try to read into the market, is that can I sense the greed? Why is there a need to sense the greed? Because when there's a greed in the market, it also means that this price may be overvalued. But whenever there's fear in the market, which may not be bad if you're not in the position, it also means that there's an undervalued situation. Everyone is selling. Whenever there's confidence, maybe it is time for us to take a second look to restudy about the whole situation. Could it be time to get into the market? So we're going to study into the market psychology today. Next slide. So it's always an honor and pleasure to be here. And I have a mission statement to be on the platform. And I hope that what I shared were able to create a lateral thinking skill for every investor traders, including the institutional investor as well. Knowing when to take a calculated risk like today, and definitely a bolder risk when there is an opportunity. So yes, I'm going to talk about risk that lies ahead. But again, when we know what's the risk that's lying ahead, I'm not seeing risk anymore. I'm seeing opportunity. Next slide. Now, so this is what we're going to go through, which is I'm going to first cover about what I know about market psychology and trading. Then after that, I'm going to move on to study the mass market behavior, where I believe that most of us will have went through that before as a retail investor, but it's good to understand and study about them because it represents the mass market. Through this example, we're going to study and dissect into the greed, fear, and the confidence. Then after that, I'm going to give you some example on the crude oil and also an example how to apply that in inflation, of course, followed by Q&A. Next slide. Now, how do I define the market psychology is this? Now, behavior price movement refers to the fluctuation in price of a financial assets that are caused by a collective behavior of investors, traders, events. And I noticed that all these behavior patterns, it tends to repeat itself again and again. Now, again, it is not absolute, it is relative. So if we think that is absolute, then we're going to fall into the trap because there's always a 30% risk. Then we have to, if we are wrong, we just have to manage that risk effectively. Next slide. Now, let me just impress you a little bit, but I think beyond impress, what I'm trying to share with you here is that with this 1 hour sharing, I hope that later on, as you go back to your office, at home, when you analyze the market, this skill can be transferred to you as well, that you can seize the risk and the opportunity as well in your office, in your desk, and at home. Now, so on the 21st of July 2021, I have this sharing. Now, I want to bring you back to 2020-21. How was the market like back then? Was there inflation? Was there a higher interest rate in 2020-21? I think most of us have forgotten in 2020-21, there's no such talk about that inflation is here and there's higher interest rate. Yeah, there's no such talk about. But yet, in our sharing in platform like this, we identified that during that period, 2020-21, inflation is on the rise. And perhaps for that reason, higher interest rate will to come. Now, so this is what we shared. Next slide. Now, it may be technical. I think most of us understand about what is a hammer just by studying into price behavior. When we look at a chart, what are we studying into? Now, if I'm going to reconvert this chart to data, so the data scientists will be very interested here today. Honestly, we're doing data analytics, but data analytics will be very tough for most of us to understand. But if I'm going to convert this data to a chart, it forms patterns and pictures. So what we studied was the 5 years interest rate, and the 10 years interest rate. And that was 2020-21 in July. And I've recognized that then the interest rate for the 5 years was at 0.7%, and the 10 years was at 1.2%. Now, by recognizing these patterns, I assume the studies is that perhaps interest rate is on the rise. So personally, for my investment, whatever is on loan, on leverage, I try to deleverage because it's not wise when interest rates on the rise, you're heavy into borrowings. I'm referring to my own property investment. It's time to deleverage. So of course, I also share this message to my friends and those who are willing to listen. Next slide. So what happened where I prepare all these on Monday? So this was what we saw on the 5 years interest rate where it became so micro at a point in time, this little hammer. And today we're at 4 I can't see, so small. So that's what happened when you're 51 years old, you can't really see well. But I'm glad that wisdom grew along the way. So can't see well is all right. We use more of our brain. So today the interest rate was at 4.7. Yeah. But the float rate is 5%. The Fed fund rate is 5%. And there's an inversion right now. And let's go to the 10 years interest rate right now. Maybe just shrink a little bit. So what we discussed that in July 2021, it was this little hammer here. It seems so insignificant then, but today it's at 4.1%. Next slide. So again, it's not to impress you what I can do, but more than what you can do at home. We can recognize pattern, and when we understand the pattern, we try to take it a little bit more seriously, study the macro development, the micro development as well. Does it match to what we are seeing here in the technical or data analysis? Now, so what do you think about this 40 years interest rate? I'm not talking about the interest rate. And do you think that interest rate is on the rise? Now, next slide. Now, if I'm going to draw a very simple trend line like this. Next slide. And I believe that this is from 1970s to today. And what we're seeing here, the post-COVID interest rate, it seems to me that you have just broke this major downtrend line. And I think it is interesting, like what Melissa said earlier, it is time to look at the macro development, the geopolitical risk, what will cause commodity to rise, and will there be a risk that inflation is going to continue to rise, so that the Fed will also consider to maintain or hike the interest rate in the near and far future. And I believe that there's some risk moving forward. So again, we're not going to talk too much about risk, but rather how can it make use of this risk that we know ahead, turn that into opportunity. Next slide. Now I'm going to talk about this is going to be a little bit fun now, some animation. And we're going to study into the mass market psychology. I think many of us, before we became an institutional investor like yourself with your company, we were once an individual investors. Now, I'm not here to shame the individual investor, but rather as I shared this, I hope that the individual investor will also be blessed. Because if we are into folly, but yet we're able to learn what we have done, the mistake we've done in the past, we develop an interest, we develop a skill, we can all become better. Now let's study about the characteristic of a mass market psychology. And I'm going to discover about this characteristic, this investor, her name is Catherine. And now if you come across any individual that always like to say this word, and as investors and traders, we try to minus off, cancel off this vocabulary in us. Now, it may happen to you. For example, you have taken profit and the market run up even more. That you may say that I should not have taken profit. Try to minus off that off because you are blaming yourself, which is harmful because over time you will create a lot of emotional baggages. Or if you have cut losses, then market rebounded. Then you ask yourself, you blame yourself, I should not have cut losses. So this is harmful over the long term. Now, so how do I recognize the mass market? Because there's a common vocabulary that they use. They like to say, I should not have. I should have. Now, next one. Now, this one, you need to go a little bit faster with me because this is an animation here. So we're going to study into the mass market behavior. Now, let's move on. Next one. Now, usually the mass market, I'm talking about the retail investor. So as an institution, it's good to understand what the mass market thinks and behave. But again, of course, we're trying to help them, not to corner them. That's not the whole idea. Now, usually the retail investor, or the mass market, they are ignorance. We have to recognize that. When the price dropped a lot already, my friends say that it is a good time to buy. I will buy now. They invest and trade out of ignorance. So as the price dropped even more, next slide. Next slide. Yeah. They say, oops, it is okay, or I buy some of the average rate, and they average on their losses. So we don't do that. Move on. Next one. See, I'm right. Next one. Stress. Next one. So then the first mistake they made is that they average on their losses. When it broke the low, they are so stressed out and they cut loss. Now, the emotion is this. We try to read into the market development. We try to read into the mass market emotion. When they over-leverage, overstick what they have, likely it will cause them to cut loss. When they cut loss, it also means that market is undervalued. Could there be a proposition on buying opportunity? We're going to discuss that shortly. Now, let's move on to the next slide. Sign, please don't tell me I cut at the low again. Move on. See, I told you market is coming down. Next slide. I don't believe this. Never mind, I'll wait for it to come down or buy again. So he is getting a bit angry right now, or she, because I'm referring to Catherine. Next slide. But market do not wait for her. And this is the time that we have to recognize if the market on FOMO mode. FOMO means fear on missing out. Now, because it's so high, for example, where is the FOMO today in the stock market? In the AI chase, in the AI euphoria that we're seeing. There's a lot of FOMO. And a lot of us are thinking, I should buy now if I'm not going to miss it. Why I say so? Because I literally every place I go to, people always ask me, which AI stock should I buy now? It's so high. So there's this euphoria that's going on FOMO. So we have to recognize is that stage of whatever product that you're investing and trading in right now is in a FOMO mode. That means that the price at this point is overvalued. Move on. So after she has invested, market dip. Next one. It is a good stock. I am a value investor. Now notice that Catherine started as a trader. But when she lost money, she got a bad experience here. She said trading don't work. Then after that, she became a long-term investor. So we can recognize the patterns of the mass market behavior. Next one. And I cannot believe this. Okay, let's move on. Now, so we're going to recognize when we look at any market, so this is just one example. So what market was that? I believe that there was a gold market, but it applies to almost every market. So that when we look at, it could be crude oil, it could be gold, it could be the yield, it has all this very similar behavior. But more than that, I want to recognize the emotion behind all this mass market. What is it all about? And how to recognize the market, whether there's an element of greed. Let's move on to the next slide. Now, based on this story that I just told you, a case study for you. Yeah, I think it's always good that we have some practical experience. At any particular point, where do you find that the greed is in play? Which point? I'm not going to ask you to stand up to answer me. It's okay. But just take a moment to identify this progression. Where is the point of greed of the mass market? Okay, next slide. So I think most of you are right. So we have to recognize where is the FOMO, fear of missing out, and they're buying huge. Yeah, and it creates an overvalued situation, and that may be a situation that you can consider you should lighten up and to take partial profit. Next one. Now, so it's very different from this stage because again, at that point when Catherine bought or invested mass market, they bought out of ignorance. Remember that as the price dropped, she continued to average in. Yeah, it's out of ignorance. So there's a difference between out of ignorance and FOMO. So FOMO is usually something that I'll look out for in any markets. Let's move on. How about, can we recognize where is the fear? So we have just identified how to recognize the greed, but how can you recognize the fear in any market based on the demonstration? Next slide. You're just going to take a few seconds to analyze where is the fear. I can tell that this practical exercise is good because I suspect that after this session, I'm not too sure if I'm going back to the office. Some of you gentlemen over there, you may want to look at the market that you're trading in or investing in right now to identify where's the fear and where's the greed. So where is the fear? So I think this is quite easy compared to the greed, right? Let's move on. So the fear is this, out of ignorance. They keep on buying, averaging, they commit their mistake again and again until the market falls so deep that it hurts their emotion, it hurts their pockets, and out of that emotion, they just throw the market. And it created an undervalued situation. And that could be a situation that we should take a closer look at any market. Now let's move on. Let's move on. So like what I say, out of ignorance, it may create fear. Out of FOMO, it may create greed. And then how to identify the confidence of the market? Let's move on. And I hope that this data point are useful for the data scientists. I'm not too sure how it works, but I hope you'll speak to all the data scientists, then things will get into more productive into your system. Now let's move on. Now, how to identify the confidence? Now, this is something interesting that I want to take note of. So we identified what's the fear. We have identified what's the greed. Let's move on to the next one. Now, let's move on. Next slide. Now, could you see that we have discussed about the fear and followed by the confidence? Now, what we have to understand here is that maybe we move on to the next slide here and next one. Now, could you see that with Catherine, the mass market created a fear, but suddenly the market also moved up. And I'm particularly interested in any asset class or any instrument when this thing appears. Despite of all the negative news that created so much fear by Catherine, despite of the negative news still intact, I don't see any positive news around. And suddenly I could see that the price behavior started to edge up with huge transaction volume without the absence or with the absence of good news, then I'm a little bit suspicious that could it be an insider's trading that's coming up, or could it be someone, it could be a fund or many individuals know something that is not available in the market. So that's what I work in the arbitration or to help the attorney or the lawyer solve some trading dispute using this. So to summarize is that how to identify confidence is despite all the bad news that created Catherine to sell off, what is causing the market to move up with the absence of good news? Now let's move on. So that created this, what we call the bullish engulfing body. And if you combine these two together, you are able to see this price behavior where we commonly know as hammer. Do you know that when you combine these two together, you will get a hammer? And remember just now we saw that 2 years and 5 years, or is it 5 or 10 years yield? We saw a very classic hammer. But if you're going to combine these two together, that we saw a hammer. So for the yield, I've been waiting for some years for that to happen in July 2020-21. I need to see that price behavior that's speaking to me. But before that, I know that the macro development are building up for a higher interest rate that we're in today. Now let's move on to the next one. Now, how about this one? With the greed, with so much good news like today, the AI hype, for example. But what I'm looking out is that despite with all these good news, there's no bad news, suddenly this thing appeared. Next one. Next one. Now, with so much good news around the AI, it seems to me that today, a lot of investors have forgotten about the risk of inflation. Many of us, I'm talking about the mass market, have forgotten about there is still a risk of inflation because it's overshadowed by the AI hype. Now, with so much good news and suddenly if the market turn, we'll be quite concerned. I'll be looking out, I will start to analyze what actually happened. And this is what we commonly know as the bearish engulfing body. So when we look at all these patterns, it's not just patterns by name, but we have to understand what is the psychology behind these patterns. That's just how I use to identify all these turning point, the macro trend. Now, next one. Now let's apply. So I just share with you some fundamentals about how to identify the turning point. Let's look at the application right now. Now let's move on to the crude oil. Now, this was prepared on 17 August 2021. At a point in time, my expectation that crude oil will edge up to today nearing about 90. And I suspect that in the near and not too far future, we're expecting crude oil to go above 100 US dollars and more. Why? Now, let's base on what we have discussed earlier on this crude oil over the last 20 years. Next one. Now, first of all, we have to understand that some macro development back then in the before the 08 crisis, the main supply for crude oil was mainly OPEC, and there's a new demand by China. So we could see that the market have overdrive, and it formed that there's this euphoria in the crude oil. Now, we could see that there was an inverted V. So earlier what we studied is all the inverted V shape and also the V shape, a sharp V shape that forms bearish engulfing body or bullish engulfing body. It also forms hammer and inverted hammer. Yeah, so do not just understand it by name, but try to understand the psychology behind the development. That's more important. Now, next one. Now, if we could see that this inverted V is also a bearish engulfing body, and we could see how the market have turned. Now, next one. In 2008, of course, we knew that there was 08 crisis because of the subprime. Let's move on to the next one. 08 crisis, next. And we saw that there was a V shape, a very sharp V, which is also the bullish engulfing body. Next one. And because of the OPEC and US shale standoff, the market have dipped, and we saw a V shape, which is also next one, which is the bullish engulfing body. Next slide, please. And this will be very familiar to all of us, which is just happened about 3 years ago because of the supply chain block. And it requires the producer to spend more on the storage of oil and the cost of oil price to dip below par. But I want to take notice that this is a very sharp V. When sharp V happens, it also means that the potential upside is very strong as well, technically. Let's move to the next slide. Next slide. Can you see that there's a potential sharp V? When you combine these two together, you'll form this hammer as well. Now let's go and study a little bit more intimately on some fundamental about the crude oil and the rest of the commodities. And then we're going to narrow down to the CPI, and we're going to narrow down to the interest rate. Volatility will come, but I will embrace it as an investor and traders as well. To me, it's all good news because with volatility, there's definitely so much more trading opportunity that's around. Move on. Now let's apply inflation. Let me just give you some progression, what's happening to the market. Move on. Now, US bank run, it was March this year. The bank run was caused by high inflation. But today, I think many of us have forgotten that there's a bank run ever exists. But I can tell you that the bank run crisis is still there because if you're going to study into the 4,000 stocks, banking stock in the United States, it seems to me that only JP Morgan is above the March prices high, and the rest of 4,000 banks is still below or around the March crisis prices. So the price behavior speaks to me that the bank run crisis is far from over. So we still have to look at the banking stocks very carefully. Now, but I would say that the market at the moment is giving us a lot of hints why it's coming right up. Let's move on to the next slide. Now, I got this formula. If you ask me that whether inflation is on the rise, I will look back at commodity prices. Or if you ask me whether interest rate is still on the rise, I will look back at inflation and I'll look back at commodity. So therefore, we have to study about the raw data or the raw prices of whatever we need and we use daily, which is commodities. Next slide. Now, this one may appear a bit complicated, but it's easy to understand. The yellow lines represents the commodity prices, which is crude oil. This is crude oil. And the yellow is or the deep orange is CPI and followed by interest rate. Now, let's look at what happened to the COVID-19 where the crude oil went below par and it rebounded to this exceeding 100, which is not that long ago. But you notice that when did the Fed decided to hike interest rate despite of a rise in commodity prices, using crude oil as an example? It took them, next slide. As oil price and rest of the commodity rise, it took the Fed, next slide, 23 months later to decide to hike from 0.25 to 0.5%. So what I'm trying to suggest here is that the formula to understand inflation and interest rate is first we look at commodity prices because that is the real data. Where is the commodities today? Is it higher than before? Then we will know that what is the CPI, whether it's a core or CPI is going to do, because all this data, the agency need all this data to feed them. It could be a few weeks to a few months later. And the central bank will take much longer period to identify whether are we still in inflation or not, to hike, pause, or to ease the interest rate. And we could see that as oil price rise, it comes to a point that CPI, there's an exponential effect. Now, another example about the lagging effect between these three components, which is commodities, inflation numbers, and interest rate. Next slide. Well, the oil price reached a high and it's to move down over the last whole year. In 2022, the oil price dipped. But it took the CPI, next slide, 3 months later to register the peak. Then it started to come down. While the interest rate is still maintained at a high, because I believe that the Fed understood that all these data points are still elevated. When I say all these data points, I'm referring to all these commodity prices are still elevated. And Jerome Powell did say that we studied into my predecessor in the 70s and 80s. We do not want to cut the interest rate that soon, because what happened back then in the 70s and 80s was his predecessor cut rate too soon. And then we all know the story that the CPI started to reverse up very strongly. He do not want to commit that mistake as of yet. But yet, during each FOMC conference, I could see that the gullible reporter asked him, are we going to cut the interest rate? They're very gullible. Why I say so? Because this reporter are basing on a CPI of last year, June at 9.1 to about 3%. They say that the inflation have come down so strongly. It's time to cut the interest rate. But what Jerome Powell and his team are looking beyond the last 1 year CPI. He's looking the last 40 years. And he knows what's on the table. And he's very consistent with his statement over the past FOMC meeting. He said this, we're going to study into the data point, month to month, data to data, the totality of the data before we decide what we're going to do next. So basically, in short, he's asking the reporter, please do not put words into my mouth. We do not know, but the data will present us to the fact for us to make that decision. Let's move on to the next slide. Okay. So what do you think? Moving forward as the crude oil from about this low, I believe about 40, and today is nearing about 90 US dollars. The crude oil is on the rise. So what do you think about the CPI will do? From 3%, the latest reading was at 3.2. And now we could recognize why the Fed want to maintain the interest rate at this high point, either to pause or to hike, which I believe that in 2024, my personal conviction here, based on my reading, is that unlikely it will cut an interest rate in 2024. And I hope that that will bless you, because again, I say that if we know what's the risk that is ahead of us, I'm not seeing risk, but I'm seeing opportunity. Now let's move on to the next slide. We have just discovered about crude oil. How about the rest of the commodity prices? Now, this was a COVID low, and this was a crude oil that we study. But among all the commodity prices, now how I measure inflation and interest rate is that I like to look at this group of CME commodity prices. I listed all of them, the top 16 of them. So you're seeing my first page here. But what we could see here, since COVID low, the gold is still around 2,000. oil, where we just studied. And I believe that oil is in a bull trend, and the last year dip was a retracement dip for bull to come. It's not a turnaround based on the geopolitical tension that we're seeing, based on could be the dollar that I'm seeing here. Over the last 1 year, since September last year, the dollar has been decreasing based on the dollar index study that I did. But look across all the commodity based on the COVID-19 low, most of the commodity prices are still elevated, and the meat price, the cattle, the live cattle have broke its all-time historical high. So what is my reading here on the commodity prices? It's still elevated. Next slide. And so what's your reading? Next one. So let's do a case study on the long term. And now I'm going to pass the table to you to analyze, where I have not discussed about this topic. Earlier, I shared about hammer, inverted hammer, to understand the psychology behind the hammer, inverted hammer. Now let's look at this case study on the crude oil prices based on the price behavior study. Next one. Now my question to you is that this is a yearly chart of oil since the 80s until today. Now, based on behavior science, what is your reading over the past many years? And I'm reading from a yearly chart. Sometimes a few seconds to analyze on this price behavior on the yearly chart. There's a lot of geopolitical behind the behavior. I just want to share with you my excitement about how I look at opportunity. Can you see that there's a lot of opportunity? Maybe I'll give you one clue. Next slide. I'm going to draw a straight line across. My question to you is that what can you conclude on its price behavior movement the past years based on this straight line? I think it's interesting. Now, what I reckon here is that OPEC, and it developed to OPEC Plus. OPEC Plus have never been so united before compared to the past. In the recent years, they are even more united. Now, what I could see that over the past years, they have tried to break above 100 US dollars, but it failed. It tried numerous years to break above 100 US dollars, but it failed. And after COVID, they try again, it failed. And now with OPEC Plus, so what is your reading? Now let's look at the next fundamental development here. Next one. So what I'm seeing that perhaps in this behavior, they are trying their best to break above 100 US dollars, but they failed for numerous times over the years. So could it be telling me that maybe in years to come, they are trying to break the upside? Perhaps. Yeah. Now let's look at some fundamental development. And we all knew that. Next slide. The first time that I read about this OPEC Plus that to cut oils of production is on April 2023. So we all knew that for commodity prices is that supply with lesser supply, the same demand, commodity prices should go up. So this is something that is very basic to understand. Now, where I believe that this is going to be a long haul, OPEC Plus, their decision. Now let's move on to the next slide on our analysis, where on our 10th of April 2023 sharing. Next slide. So this was what I shared. I read about the news on the 3rd of April. I saw this gap. This was the first time I read about OPEC Plus coming together to reduce the oil production in May 2023. And I saw this gap. So my projection is that I believe that you will try to break, retrace, and ultimately will break 100 US dollars and will move higher. Now, there's many reasons to look at oil prices and commodity prices. Geopolitical issue, OPEC Plus is another specifically for oil market. But what's the end result based on our April reading? Let's move on to the next slide. And what we're seeing is almost on track here. It retraced from about $65, it moved up, retraced, and now is nearing 90 US dollars. So I want you to relate not just oil, but the rest of the commodity prices, and how would that translate to the CPI? And then how would that translate that to the interest rate? Yeah, so this is something that worth to take a look at. So how I understand about inflation is I have one page, a few pages of CME commodity prices where I look at them. Next slide. So this is a yearly chart again. Next slide. Now, so we saw in 2020-23, after bank run, the US stock market rally because of credit to the AI rush. So what's coming ahead? I believe that market has given us a lot of hints. So today we discuss about the lagging effect between the commodity, inflation, and interest rate. Let's move on to the next slide. We also understand about this 40 years interest rate. And what I took interest is that you have broke this downtrend line very convincingly. Just combine what we have discussed. Of course, today we have done time to discuss about all the geopolitical issue, but I just want to narrow down to the behavior signs of the price movement. And we could see that where is the inflation moving ahead based on the commodity price that is developing right now. Let's move on to the next one. And that was a Fed fund rate over the last 40 years. But if I'm going to look at the 2 years yield, 5 years yield, 10 years yield, 30 years yield, these are the cash market. And I got all the very similar reading over the last 1 year. You have broke above this 30 to 40 years downtrend line, whether it's at a Fed fund rate that we saw earlier or the 2 years, 5, 10, 30 years yield. Now, all these are cash market. Can you participate in trading and hedging into the rising interest rate? Over the last 2 to 3 years, I cannot remember the specific launching of the CME micro yield futures. You can take a look at all these contracts, the micro 2 years yield futures, to participate and take advantage of this rising interest rate to come. Okay, next slide. So a lot of them ask me about investment and trading. They say, Kon Hao, what do you like to invest in and what do you like to trade? I told them that whatever that I find that's interesting, that's about to move, I would like to participate and trade them. So I don't limit myself to just one contract. I open up the net as wide as I could. So one of the first few platforms that I use whenever I see whatever market that's interesting, I'll look at the CME platform. And I like to use this platform here is that I include the QR code here. So I'll look at the study daily about the agriculture. So once you click into different ones, you're able to study into the contract specs and more details. But moving forward, as what we discussed, agriculture is something that I'm interested in. Energy, that's definitely something that I'm interested in. Equities, I find that there's an interest in it. We have studied about the AI hype. I'm waiting for the confidence to come in before I take action. So which I believe that is not too far from this point onwards. Next slide. So there's also Forex, interest rate, where we discuss about the all the different terms, tenure, the 10 years notes and the 30 years note futures. Metals definitely are very keen moving forward. And the micro yield that we spoke about, you can find that in the micro futures. Next one. Right, so if you're going to ask me that, is there a way to interpret these option prices or implied volatility in a very meaningful volatility estimates? And the good news is, next slide. Last year, the third quarter, CME launched this CME Group Volatility Index. Now, it's not an index to be tradable, but rather it's a benchmark for you to look at the volatility of the market. For those that take interest, what is it for? Is to access, for the first time, access across asset class family of implied volatility indices based on a simple variance daily benchmark on CME data mine. Next slide. So all these are available for free, and you can study into the volatility market, each asset class and their volatility index. Next one, which is the last slide. So of course, if you have an interest in the CVOT, you can call the expert, or you can always go to their website to find out more. Last one, which is myself. Okay, so you can stay connected with me through my Facebook page. Next one. And CME Group did encourage me to produce a lot of videos. I know that today's presentation is 1 hour, but definitely they are very short snippets of 5 to 7 minutes sharing about what is happening to the market to understand deeper to do a deep dive about market psychology. So I took CME advice to produce some videos there. You can find them in my channel, Invest and Trade Insight. My website, if you want to find out more what I'm doing, and definitely be welcome to receive your email on some inputs and some thoughts that you may have. Definitely for some data scientists, if you find that you can include what I shared to your formula, I think that will increase my productivity. So with that, I want to thank you, all of you, for your kind attention. I hope that this sharing, it is a blessing for yourself in how you can manage your fund for your company. And with that, I hope to see you again very, very soon. Thank you.
Thank you very much, Mr. Wong. I'd just like to invite Ms. Melissa on stage to present a token of appreciation for the incredible speech we just heard. As we're waiting for Melissa to come up, I'd just like to say you brought back some very good memories of the open outcry trading. Please come on. And we're probably showing our age a little bit. So, but if you could just join me in another round of applause for Mr. Wong, please. For those younger members who may not have ever experienced a open outcry trading floor, can recommend some old films such as Bonfire, the Vanities, and Rogue Trader, which was actually about the Singaporean Stock Exchange where Mr. Wong had worked. So, so without further ado, I'll introduce session number 2, which is overcoming volatility with a simple and proven technique. And for this session, I'm going to invite onto stage a very old friend of the CFA Society here in Indonesia, with 25 years experience in financial markets and the globe-trotting leader of Agrodana Futures. I'll invite Mr. Tommy Zhu up on stage. Thank you.
Good afternoon, ladies and gentlemen. Thank you for your time coming to the CFA Institute conference. And I would like to share about overcoming volatility with a simple and proven technique as our second session. And please allow me to move around the stage, as I may get cramped if I just stay on the same point for 1 hour. Thank you. Okay, so maybe you have seen my profile that I have been in this industry in financial market for over 25 years. And just like Mr. Wong mentioned, what he explained, actually, it happened all the time in the market. And the trend is always repeating. So market psychology is important. And now we would like to discuss about how to overcome this volatility. Okay. Okay. Normally, when we think about volatility, it always reflects as moving up, moving down. So volatility is reflected in the up and down. And we always refer this like a roller coaster, right? But interestingly, if we see the roller coaster is swing bigger, the bigger swing, then it is more volatile. And if we see the volatility is very big, we call it high risk. When the volatility is very low, then we call it lower risk. So volatility, as we see here, like the roller coaster, and then we up, down, and all this time, we always refer volatility to risk. Yeah, this is the one I mentioned just now. If the volatility is big, then we call it high risk. And if the volatility is low, we call it low risk. So actually, next slide. If you see the volatility, why we call it as risk, Actually, in investment, definitely everyone has a certain target of return. And this is what we call the expected rate of return. And if we see this bell-shaped curve, the volatility is deviating from this expected return. So the vertical line is what we expect to have from the investment. But if our result deviate from this vertical line, it could be here, it could be here, it could be here, it could be here, then it is volatile because it's not it does not arrive at our expected return. So the wider the bell shape, then it is considered more risky. That's why we always refer volatility as risk, right? So let's try to. Okay, so if you look at roller coaster, because we always refer volatility is like a roller coaster, then what do you think? Do the people riding the roller coaster, do they enjoy or fear in the ride? Depends. I myself, I love riding roller coaster. When I go to theme park, normally I just like to see, okay, which one is the scariest roller coaster? Then we will ride this one and then enjoy. I myself enjoy roller coaster, and I believe all the roller coaster lovers all enjoy. Why? Because we know where the end point is. We will finish safely in the track. So when we know the full track of the roller coaster, then we can enjoy the. But imagine if you are going upside down, but it is in a car crash. I believe the story is totally different. So when we know the whole track, then we can enjoy the ride. And in investment, we also need to know the whole track. And what is the whole track when it comes to investment? This is what we need to think about. And in my 25 plus years of experience, I can conclude that the whole track in investment is long-term investment. So when we invest, always have the long-term horizon in mind. Okay, next slide. Okay, so if you look at this chart, this is a chart of Apple. Yeah, so this is an Apple price, yeah, Apple stock price. And you see from here, go down, go up, go down, go up, go down. So if you look at the movement, next slide. Yeah, next slide, please. Okay, if you look at the movement, Apple stock price dropped almost 30% in 6 months. If this happens to your portfolio, imagine you lose 30% in just 6 months. What will happen? You may be fearful, like what Mr. Wong just now explained, right? But then, if you just happen to invest at this low, and then, next slide, please. Next slide. And then the price go up 36% in 2 months, then what will you feel? I believe you will feel excited. Maybe you will feel like you are the smartest person in the world. You can score 36% in 2 months, right? But then if you keep on going, and then the price go down again, and also drop 30% in 5 months, then you will, wow, volatility is very dangerous. You will feel like, wow, market is very destructive to my psychology, right? And if you see this movement, it almost occupies the whole screen. It's almost touching the upper end, and it almost touches the lower end of your screen. And you see, wow, volatility is very high. So how do we overcome this volatility with a long? So if you look at the longer time horizon, so this one is around 2020 to 2023, is around 3 years. So if you see the next slide, this one is around 5 years. When you see the chart in 5 years time, actually it does not occupy the whole screen. So the up and down is just a part of the movement. And if you look at the next chart, around 10 years, the one that we see is just the the one block in the yellow color. And if you want to make it smooth, you see the red line here. The red line represents the moving average. And what I display here is the 100 moving average. So 100 charts average get 1 point. And then the next 100 chart get 1 point. So if you see the red chart, the red line, it does not display any big volatility at all. It is just smoothly going up. Smoothly going up. And if you see the next, please, next, yeah. So we can only say, okay, we know that the long-term trend is up. Volatility, it looks big only in the short run. But when it goes to the volatility is not scary anymore. And if you look at the moving average, it will see like a very smooth line going upward. So, next please. This is tips number 1 to overcome volatility. Long-term investment will smooth out volatility. So always have long-term horizon in mind when you want to invest. That's overcome volatility, tips number 1. Okay, next please. Then, just like what Mr. Wong also mentioned just now, how do you want to invest? Maybe out of ignorance and then you buy and then you want to average down some more. So after some time, the price go down, you get confused and then you cut loss. It could happen. I also experienced that, right? So what do we do with our money? Shall we buy now? Let's say, just now we displayed the Apple chart, Apple stock price. Shall we buy Apple at current price around 80? Or shall we wait for the Apple stock price to go and then we buy? Or how? Normally people will do, first thing is buy and keep, buy and hold. That's one thing of investing. The second one, they try to time the market. Timing the market means, okay, looking at indicators, looking at data, okay, no, it's not the time yet. And then when the price maybe move down, then you say, okay, this is the best time to buy. Or maybe, I don't know what indicator shows to your desktop, and then you make a decision. That's timing the market. But research shows that it's not easy to time the market, especially if you can say, I want to time the market consistently. I must remind all of you, it is not. So the third one is using dollar averaging. Dollar cost averaging means you invest with the regular impact. So with dollar cost averaging, you invest regularly. And how much do you invest? It's an equal amount. So let's say, okay, I want to invest every time I celebrate my birthday. That means once a year. Or maybe if you want to be more frequent than a year, okay, every quarter I will start investing. Or maybe every end of month after I receive my salary, then I will invest regularly. That's dollar cost averaging. So you invest regularly with the same amount. That means if let's say in your plan, in your investment plan, you plan to invest, let's say $1,000 per month, then every month you will buy $1,000 of investment. And where to invest? Let's say we discuss about Apple. So you just buy Apple stock with $1,000. If let's say today 180, that means you can only buy 5 shares. If the price drop to let's say 150, maybe you can buy 6 shares and so on. So every time you have to invest, then you invest with the same amount of money, regardless of the price of the security. So this is dollar cost averaging. So just now we remember there is buy and hold, or second, you want to time the market, and the third one is dollar cost averaging. So if you buy and hold, if you buy and hold at the lowest price, that's the best. But it is not easy to get the lowest price. But if you buy at the highest price, then it is a disaster. So with dollar cost averaging, you try to average your price instead of one shot. So this is dollar cost averaging. Now, if you look at this chart, this is just an example of the regular interval. So I'm using the vertical grid line here, and this vertical grid line can be translated to any terms that you want. Just like we mentioned just now, it could be your every month end after you receive salary, or maybe after your birthday, or every, I don't know, as long as it is regular interval. Yeah. So if you imagine, let's say the price was here compared to here. So at the first point, you can get more shares than the second point. At the third point, you can get more shares than the first point. But let's say when the price is around the peak, then you get less shares. You just keep on buying, yeah, buy here, and so on, as long as it is dollar cost averaging. So with the amount of money you keep buying. Okay, next slide, please. And what is the benefit of dollar cost averaging? The first one, you will average your purchase price. That means you avoid buying at the top. Definitely, you will avoid buying at the top because you spread your purchases. The second one, you don't need to time the market. Timing the market is very difficult, if not impossible. Yeah. And since you do it regularly, you don't need to think when to buy. You can focus on your business and your expertise. And this is what I like. Like myself, when I invest, I don't need to think, okay, when to buy, when to sell. As long as you want to buy, just keep buying with the dollar cost averaging. Just focus on your expertise. You run your business, you run your company, just run it. So this is the dollar cost averaging. So next. Tips number 2, dollar cost averaging will reduce the impact of volatility. Why? Because you spread your purchases over time. Okay. Next slide. This one is interesting, and I hope you can get the idea of volatility. Next. Let's say you have asset number 1, and your asset number 1 is having risk return profile like the chart, like the white color chart. The return can go up here, can go down, can go up, can go down, can go up, and so on. If you have asset number 1 as your portfolio, is your return volatile? The answer is yes. The volatility is displayed like this one. And remember, we want to overcome the volatility. Actually, everyone would like to have fixed return, right? Absolute return. We want to have something really predictable. This is the fund manager's point of view, right? We want to have everything controlled, under managed, right? So if you see your portfolio having the return profile like this asset number 1, then your portfolio is still volatile. The value can go up, can go down, and so on. So how can we reduce the volatility? Next slide. Okay. When we add asset number 2, and asset number 2 have the return profile as the red color chart. So when the asset number 1 go up, asset number 2 go down. When the asset number 1 go down, asset number 2 goes up, and so on. And if we combine these 2 products or these 2 assets, then we can have an expected return, the green dotted line. So it's like a fixed return when we combine, because when this one produce this high, this one minus, okay, our return is here. When this one same, then our return is here. This one, the red one high, the white one low, our return is here. When we combine these two assets, then we have fixed return. Of course, it is not easy to get a totally negatively correlated asset. Yeah, because this one is the correlation is -1, and it is not easy to find. But as long as you find the negatively correlated, then your expected return will be smooth. Maybe if not straight line, it could be like, yeah, the volatility will be very small. So what is the essence of these two assets? Basically, it is called diversification. Next slide, please. So when we do diversification, that means we would like to add our asset class. Remember, diversification must consider two things. Diversify by the asset class and diversify by the geography. By asset class means, as we know, there are 5 asset classes that normally people group, yeah? The first one is cash and cash equivalents. The second group is fixed income. The third one is equities. The fourth one is property and real estate. And the fifth one is alternative investment. So when you diversify, try to diversify among these 5 asset classes. In the equity itself, it is also have many things to diversify. If you just buy one stock, then it is also risky. You need to diversify among other industry, right? So this is the diversification by asset class and also by geography. By geography means if you put your money every month, every fund that you have only in Indonesia, then you have the country risk. This is what happens to me in '98. When I put all my money in Indonesia, and then the economic crisis happened. Even though the best company you hold, the price crash. So you need to diversify by geography as well. Means, okay, you have portfolio in Indonesian stock market, that's good. You have portfolio in US stock market, that's good. Or maybe you want to have portfolio in China, okay, no problem, as long as diversify geographically. So diversification by asset class and by geography. 2 things you need to remember. And try to find negatively correlated assets. And negatively correlated asset, if you don't know which one to choose, the easiest way to diversify your portfolio is using index-based instrument. So let's say we're talking about, let's say, Indonesian stock market. Which stocks to buy? Maybe you will mention, okay, this banking stocks, or maybe this commodity stock, maybe this consumer product stocks. But which one to buy? Maybe you are confused. Then you can refer to the index base. We have index LQ45, we have index IDX30, and so on. In US stock market, they have S&P 500, they have NASDAQ, they have Dow Jones. So this is one of the easiest way to diversify your portfolio. Okay. So tips number 3, diversification will reduce the volatility of return. Just like the chart that I show you, when you hold asset number 1 only, then the volatility of return is very high. When you choose asset number 1 plus number 2, then the expected return become fixed return. Okay, so tips number 3, yeah? Diversification will reduce the volatility of return. Then we look at this chart. This is the first chart that I show you about volatility, right? So when you look at this, actually The vertical line is your expected return, and the one in the bell shape is the probability of return that you might face. Talking about volatility, actually, if the volatility is here, that means you can generate more than you expect. Do you mind, or will you be happy to have this return when the return is higher than what you expect? You will be happy, right? So you don't mind to accept the volatility on the right. What you don't want is the volatility on the left. So you want to eliminate this left part. Next part. Yeah, the red color. Yeah, you want to eliminate the downside risk. You are okay with the upside risk. So volatility, wow, I expect to generate 10% and then it has 15%. I'm happy. But if you expect 10% and you only get 5%, then you don't want this to happen, right? So we want to eliminate the left part or the negative downside risk. So talking about downside risk, just like in insurance, we need to think from two parts. How frequent it happens and how severe if this happens. Let's say in our daily life, maybe we can easily get scratched. Suddenly scratch, and then you need to apply some medicine to make your skin recover, right? Scratches happen very frequently, but then it does not pose any harm to us. So when this happens, we are okay to accept the risk. But when it comes to something serious, let's say cancer, maybe heart problem, kidney problem, the frequency is very low, but when it happens, it devastates us. The severity is very high. So we want to protect from the high severity incident. Because if we want to insure, insurance needs money. Insurance needs cost, right? When you want to insure everything, then you may pay too much. Your cost will be too high. But if you want to insure only certain things, then your insurance or your cost will be low and it will protect you from certain severe risks, right? So, impact of the downside risk after you consider the severity and the frequency. Can we go back to the previous slide? Okay. So which one you want to eliminate? Is it the one around the center? Or is it the one on the tail? Definitely, we only want to eliminate the risk on the left side, right? Only on the outliers. If this one happened, oh yeah, I think still acceptable. Oh yeah, the portfolio generate less. How much less? Oh yeah, it's around 5 to 10%. Oh, maybe it's still considered okay, acceptable. Then you don't need to hedge. You don't need to eliminate the risk around here. But what you need to protect is this risk, the outliers. Back to the next slide. Okay, so when you hedge, only hedge the outliers. Only hedge the outliers. This is to consider the cost. Because if you hedge everything, the cost is too high and the cost may exceed the benefit you get. Okay? Okay, next. So tips number 4, hedging can give you protection from downside risk. Okay? So if you review all these 4, next slide. Basically, overcoming volatility is simple. Use long-term, dollar cost averaging, and then which product? Diversified. And if you still feel unsure about the outliers, then you hedge the risk for the outliers. Okay. Any questions, ladies and gentlemen, from this? Yeah.
Thank you, Pak, for the material. I want to ask, as a retail investors, how can we diversify geographically? I found some instrument that can be invested for US, but usually the license is BAPETI. So it's considered commodity. Is it safe for us using futures index that is regulated by BAPETI? And also how to invest for rest of the market, because right now China is emerging and also a lot of emerging market is good. So thank you.
Okay, thank you for the question. So interestingly, Indonesian investors can now access the US market. Government, through BAPEPTI, issue license to some companies to facilitate trading of the US stock market. So if you are looking for US stock index like Dow Jones, S&P 500, or NASDAQ, you can trade through futures broker. Like myself, I'm from Agrodana Futures, and my company is facilitating all these kind of products when we are regulated under BAPEPTI. And if you would like to trade the US individual stocks, BAPEPTI also approved some lists. Currently, there are around 100 plus of the stocks in the US that can be traded in Indonesia. And our company is offering 50 stocks. And these 50 stocks is all the top 100 market cap. So we can call it blue chip stocks like Apple, Amazon, Google, and then like McDonald's, maybe Chevron. So many companies in the US that you can also trade from Indonesia. So this is one of the way you can access the geographically. Before that, if you need to diversify geographically, then you need to open an account with overseas broker. But we know, right? When you open account with overseas broker, that means you have to send money abroad. Maybe the transfer fee is more expensive, and then not same day, and then the tax issue, legal issue because cross-border. But if you do everything in Indonesia, you can have the access with the ease of administration. Okay? Okay, thank you.
What about for other than US? Are there any ways for us?
Okay. In Indonesia, like myself, in Agrodana, we have access also to trade the Nikkei and Hang Seng. Nikkei represents the Japanese stock market. Hang Seng represents the Hong Kong. So currently in Indonesia, you can have access to Nikkei, Hang Seng, Dow Jones, S&P, NASDAQ. Previously, we have also the European stock index, like the FTSE for England and the German DAX. But the appetite from Indonesian investors is very low, that we only focus on this Asian and the US currently. Thank you.
Thank you.
Yeah. Any other questions? I hope with these 4 simple tips, it really helped us to overcome volatility. Always have long-term perspective, do the dollar cost averaging, using a diversified portfolio, and if needed, then try to hedge only the outliers. Thank you, ladies and gentlemen. And
Thanks. Thank you, Tommy, for that lovely presentation. I'd like to invite Mr. Harry Yo from CME Group to come up and provide a token of appreciation for Tommy and the lovely presentation. After this presentation, we'll be having a short coffee break. for 10 minutes. So perhaps if we could come back in 10 minutes time, which is at, let's just call it 4 o'clock. And so we'll begin again at 4 p.m. Okay. Great. Thank you, Tommy. Okay, so we'll take that short coffee break now, and we'll reconvene at 4 p.m. for our last panel of the day. Thank you.
Check. Check. Check.
Masukin ke sini. Nggak, Pak?
Yeah.
Itu?
Check.
Yeah.
Check.
Excuse me, everyone, if I could have everybody come back into the room and take your seats. We'll begin again in another minute or so. Ask Ram if you can. Okay, let's begin. And so for the last session of today, we're going to change it up a little bit, and we're going to go to a panel style formation. This panel is going to talk about adapting credit scoring models amid global uncertainty. To moderate this panel, I'm going to invite up to the stage Mr. Aldrich Antonio. Mr. Antonio has over 15 years of experience in risk management, audit, financial finance, and financial strategy. He's currently working in one of the big four in a risk advisory capacity. And he's also previously worked for BNP Paribas as well, France's largest investment company. I'd like to invite Mr. Aldrich up to stage to head the next panel. Thank you.
So thank you, Mark. Good afternoon, esteemed audience. My name is Aldrich, and I'll be moderating the panel discussion this afternoon. I think we have heard a great presentation from Melissa, Mark, Konhao, and also Tommy. I think from Melissa, I just know that there is such a thing as a Golden Indonesia plans for 2045. It's really interesting. And thanks to Konhao, I think I know why I keep losing my money in my portfolio of Bitcoin, Binomo, and robo trading. And also thanks to Pak Tommy, I think I realized I diversified by buying Pokemon cards. It's an alternative investment, and I think it works. Okay, so our topic for this panel today is adapting credit model amidst global uncertainty. And I will be starting by introducing our panelists. Okay, our first panelist is Joseph Sudibyo. He's a head of data scientist at Superbank. He leads the data science and analytics. Prior to joining Superbank, he was the head of data science at Ajaib, which means miracle. So we'll hear from him how his miracle in data scientist can help the bank in creating a credit model and credit scoring. So let us welcome with a round of applause for Joseph. So please take it. Okay, the next one, the next panelist is Michael Sidartawan. He's a CRO of Aman and a book author. So Aman means safe. So he's also a great risk officer, chief risk officer, and he has a great experience in fintech space on how to create the credit models. So let us welcome Michael to the stage with a round of applause. Okay, and now we have the last panelist, Ms. Melody Surya Angwin. He is a risk advisory manager at a consulting firm. He has worked for a lot of companies, and her expertise is in the credit scoring process with tools such as SAS, SPSS, and Python. So let's welcome to the stage, Ms. Melody. Okay, thank you. And probably before we start the discussion, I will start by saying that there's an old saying in a bank, right? That a bank lends money to those who don't need them, and don't lend money to those who actually need them. So this is actually a problem of credit models, right? Because actually, with the right credit models, you can give the money to those who need them, and they can pay them back. So now, I think the credit model or credit scoring, credit rating is not just used by banks. It is used by other financial institutions and also corporations. So if you look at your inbox and spam mails, you know that they know you better than even your wife probably, because they have all your data and they can do the lending on your side. So I think we also see the trend in corporates. They use scoring or rating. They want to determine who can have receivables, who can have like a lending facilities. So therefore, credit models is not just for banks or financial institutions, but it can also be used for any corporates. But it's not all safe. It's not all good stories about credit lending or credit models, because the sting of global uncertainties are still with us. The scars of COVID is still with us. So what does this matter? Because it requires the push for more accurate credit models, more accurate credit ratings and scoring. And now we will hear from our distinguished panel, how can the credit models can help us navigate the uncertainties, the global geopolitics, or probably disasters, or even climate effects to our economy. Well, without further ado, I will start these discussions with Michael. Michael. So, Michael, can you help to enlighten us that amidst the global geopolitics and market conditions, can you share how fintechs in general develop and implement the credit models?
All right. So thank you, Pak. So hello everyone. My name is Michael. So I would say I have an experience of doing as a role as a CRO during the COVID-19 pandemic, right? So it is not an easy time, but it was an interesting time, right? Because you get the first-hand experience on how the market changed, right? So maybe this is talking coming from experience. There's no right, there's no wrong. It's just that things that I think we observe in the market, right? That's an interesting learning on how we can bridge that for the ongoing, right? So I have an experience in several of the fintech companies, right? So as you know that fintech is a different kind of lending compared to, I would say, banks, right? Because their target usually serve the underbanked, right? Somebody who might not be able to get credits from the bank, then fintech can serve them. So a lot of things, I think, focusing on the discussion, what has changed and what is the learning is that before COVID and after COVID, there's definitely things that is very different, I would say. So the first one that we notice is that whatever is there pre-COVID and whatever is there after COVID is actually still following the same principles, right? So meaning that there is always high-risk customers, there's always a low-risk customers, but the thing here is that the relative difference might not be that much change, but maybe the whole level of delinquency is increasing during the COVID, right? So meaning that if you have 100 customers, you can still identify these ones are lower risk, these ones are higher risk, but the absolute delinquency is actually increasing for almost everybody, right? So I think this, to me, it's very significant because it follows the principles that whatever that we learn in managing risk is actually still holds during the good times and during the not so good times, right? It's just that how we can try to spot the trend change, I would say, right? So if we are talking about modeling, if we are talking about the data, I think most of the people here should be familiar, especially if you guys coming from the data science background or work with data a lot, right? So the thing here is that in terms of modeling, it's actually evolving. Before COVID and after COVID, it's actually still evolving, but it still follows the basic principles that if you are getting the data from these customers, you just need to be sure that the data you gain is actually verified, right? Meaning that what I personally noticed before and after COVID is that when COVID comes, there's a lot of bad actors, meaning that somebody who wants to defraud financial institutions is increasing, right? So it's not that people suddenly turn bad. It's not like that, but it's just that the needs for credit, what we saw is actually increasing, and several of the fraud actors are actually catching up on gaming this opportunity, right? Because people get more desperate, they are getting harder to get credit. So they are offering this service more and more for people who needs this, that they are helping these people. If you want to be approved, you just need to do it like this. You just need to do it like that, right? So this is what I think the main difference is that during the crisis and before the crisis is that the profile has not changed, but the incoming mix of your portfolio could be a little bit different because of these actors, right? There are so many things which I don't think we can cover, right? Because it is a very interesting things, but these two are, I think, the most outstanding ones. If we want to manage the volatility, I think lesson for, let's say, another cycle, which I'm sure it will come, right? Because it's always a cycle. That for Indonesia, I think these are the two things that we can try to highlight during the next crisis, right?
Thanks, Michael. So what I think just to clarify you a bit. So what you think after COVID, there's a rise in delinquencies, there's a rise in fraud, and can you share with us what are the tips and tricks on managing all those issues? Is there any changes in the models or something like that?
So what I think practically then, if it comes to how we try to mitigate the risk on both fraud and credit, is that especially on fraud, right, in the fintech space, how we can spot this kind of things is that we saw a pattern change, right? So if, let's say, I'm just taking a simplified example, that if you have, let's say, an application that comes from iOS and Android, let's say 60-40, right? Then during that period of time, the Android incoming mix is actually increasing to about 70 or 80%, right? Only for those periods, especially 3 to 4 months during the height of the COVID, that then it's slowly, gradually coming down again. So that's only one of the example, right? So I think if you want to try to mitigate, to try to spot whether you are under an attack of fraud actors, it's you can try to see whether your incoming mix of portfolio of the application is actually changed a lot over a short period of time, right? I mean, it's a different with credit. If you saw a fraud pattern, it's usually spiking very fast in a very short of time, and then it will coming down very fast again, right? So it's just that you need to be aware to catch this and then react accordingly. While for the credit, it's usually take a longer time. But what we can see in the portfolio mix is that when the crisis comes, it's usually impacting their ability to pay, right? So meaning that they are still want to pay, but the amount that they are paying on average usually seen reduce over certain segments which is impacted, right? So if that trends is changed, not on a short period of time, but over a longer period of time, let's say 3 to 4 to 6 months, then that's definitely things to be worried, which you can see also in the score performance that it will start deteriorating over time. I think those are the lessons that we can try to be more aware.
Okay, so yeah, that's from Michael. From fintech perspective, I think there's some key points here. When you deal with some changes, with the volatile times, uncertain times, there might be some patterns that you can see. So Michael said some delinquencies rate are increasing, and the verifications is getting more complicated, issues on that, and the fraud is also increasing. So I think one important message from Michael is that you can look at the simpler patterns, or you can look at the more complex patterns. But if you look at the more complex patterns, it takes time, which is on the credit side. But there is also a way for you to notice that there is simpler patterns that you can identify. For example, it is something interesting because let's say like 40% from 60% Android and 40% iPhone. If it increases into 70-30, then there might be some spikes that shows some issues there. So yeah, thanks, Michael. So I will move to Pak Joseph. So Pak Joseph, I think from your background in digital banks are quite new in the industry, right? And while we know that to get data for credit models, you need a long amount of time. So in a digital bank space, how do you cope with that? How can you create how can you create a credit models based on the limited amount of data in a digital bank?
Thank you for the question, Pak Aldrich. Hi, everyone. I'm Joseph. I'm a data scientist at Superbank. But for that question, actually, there is no one trick to do this if you don't have any data, right? I mean, at this point, even in my current digital bank where I work, we don't have any data points, right? And I think there are multiple ways to approach that, because traditionally, if you want to build a credit scoring model, you need to basically have data to train the model on. But at this point, and for similar companies at similar stage, I think the way we do this is usually with a combination of trial and error, and also like using the existing solutions that are already out there. For example, in terms of credit scoring itself, we have a credit bureau here in Indonesia called SLIC by OJK. And then it's the equivalent of FDC or FinTech Data Center for FinTech. So basically this credit bureau contains all of the information that you need to evaluate the credit worthiness of a customer traditionally, meaning like, for example, if I have an auto loan, KPR, a house loan, and also like other type of loans, it should be contained inside this credit bureau. So there are a few vendors, and using this credit bureau data, you can actually evaluate the customers. It's not perfect because, for example, for SLIC, currently only data from banks and multi-finance are included in there. Maybe some fintechs are also uploading to SLIC, but it's the data points are limited, and also like there are delays, 1 month delay because bank has to report only at the end of the month. So using this, you can actually evaluate the credit worthiness of customers is first point, but then is it enough? Because what happens right now, like digital banks and fintechs are sometimes after the same customers. Like initially more traditional banks, they are after customers who have a long history of credit. But nowadays, a lot of the banks want to go to the underbanked segment, right? Which is those who maybe have an account, have a saving accounts, but they actually are not eligible for credit because the traditional way of doing credit evaluation, like you have to have a credit history first before you can get your first loan. But the emergence of alternative data sources, so things like telco score, all of the big three players in Indonesia like Telkomsel, XL, Indosat, all of them actually offers telco score. So they could actually evaluate your credit worthiness using your behavior with the network, meaning they are able to understand how you are spending with them. You know, what time do you make your calls? What type of websites or applications do you have on your phone? For example, if let's say in the particular month, a user is opening like 30 lending apps or 30 lending websites, then you have to be suspicious, right? Like, does this person, you know, is it worthy to give credit to this customer, to this type of customer? So usually digital banks and other fintechs actually also leverages this telco score as one of the way to evaluate before they can create their own model, because they don't have data at first. But in addition to the telco scores, I think a lot of companies, fintechs, digital banks are already using telco scores, credit bureau data. But what about things like e-commerce data? What if we can understand your behavior in Tokopedia, in Bukalapak, or in Shopee? Can we actually guess your income? Or maybe I'm not saying income, but your capacity to pay, like the way you spend, the categories of items that you buy. Like, do you buy only groceries? Do you buy expensive items? Actually, a lot of things are going into that currently, that we are trying, a lot of companies are trying to leverage this type of alternative data source in order to evaluate the credit worthiness of a borrower, basically, simply because the borrower is underserved or even unbanked, right? They don't have a bank, then how can you evaluate their history? Yeah, there are a lot more data points that we actually can explore. Like, for example, in addition to that, there has been research around like social media data. I have not seen successful use case on that, but things like, in addition to e-commerce, ride-hailing history, yeah, basically any transactions data, or even, for example, if you use your mobile wallet, right, to do transactions, we could actually get your, I mean, of course, with the customer consent, if you decided to share your statements, bank statements, or like maybe this e-wallet statements, we can actually build a model to categorize how you spend in this e-wallet, in this bank. From there, we know like what your cash flow is like, how big is your income, what are the things that you spend money on. For example, if you are spending money outside of Indonesia, then we might consider you a more affluent customer and things like that, versus if your spending is only like, for example, groceries and things like that. Of course, there are limitations to this because currently, depending on the bank that you use, right, and depending on the customer consents, like a lot of customers actually don't want to share this type of data. So it's kind of hard also. But usually these are the things that we are doing, that we do before we have enough internal data to actually train the model on.
Okay, thanks, Joseph. So I think there's some interesting point, because actually no data doesn't mean that you cannot create credit models. But what you need to do is look at what are the alternative data available, then you can build a model on that. But probably with the new law, it's going to be a bit more complicated, right?
Yeah, correct. Especially with the new law that is coming up, taking into effect next year, right? Around Q4, the UU PDP, or like the data privacy protection law. Like whenever we receive a data, or whenever we want to use the data for something, actually the customer must give their consent. And in addition to that, the consent need to be specific. Like, what is the purpose of the data? And what is even more complex is the customer needs to be able to withdraw their consent. So like, for example, if there are cases like pretend that we already received the customer data, they have consented, we have built a model around the customer data, but then suddenly the customer called the bank or the financial institution on, oh, I want to withdraw my consent to use like my Tokopedia data, my e-commerce data, or my bank statement. Then what will you do with the data that you have already collected? Like, how could you purge the data within the time frame that the regulator needs you to delete those data or to stop using it? It's kind of tricky, and I believe like a lot of data professionals are trying to navigate the rules right now, because I think from a lot of data professional perspectives, the rules are quite strict,
Yeah.
I would say. Yeah.
Okay, thanks, Joseph. So yeah, I think you made some important points about the data availability and also on the regulations on the data that you capture and what are the data that you use in the modeling. I think there's such a thing as a machine learning, but probably there will be a machine unlearning, because once you purge the data, you probably have to take it out as well.
Yeah.
And you remind me of my Tokopedia account. If those guys knows what I'm buying in Tokopedia, it's probably I need to be scared about it. Okay, thanks, Joseph. I think to Mel, I would like to know from the perspective of a bank, because banks are the pioneers in credit models. They have been using it probably for 20, 30 years. And with the problems that we had and with the global uncertainties, they are moving into a new generation models. There's one that we're familiar with. It is called EWS, Early Warning System. So can you inform us why are they going to that direction and how are they implementing the EWS in terms of the credit decisioning?
Okay, thank you, Aldrich, for the question. Hello, everyone. My name is Melody. So basically, maybe we all are having a banking account and then performing the transaction via the bank and things like that. Maybe we are quite similar with the retail transaction and things like that. But maybe on this term, on talking the EWS specifically on the wholesale banking, so maybe if we say like what already Joseph and Pak Michael said, it's more onto the retail thing, but maybe now we are coming to the non-retail one. It's quite limited on how we use the data basically. So if we're talking about the retail, you can say like using the e-commerce account, we can define their transaction pattern, then using the maybe e-wallet, things like that, we can define a new data points that we can use to create a model. But in talking about the non-retail segment, it's quite limited. What we can get maybe like the financial statement from the wholesale debtors, and also now we are exploring the transaction data that coming from the specific bank, for example. So if we are talking about the EWS and now why we are moving towards to developing that kind of model is basically bank already have a credit rating or credit scoring model. Most of the bank, I suppose, unless it's digital bank, maybe it's quite limited currently, but I suppose all of the banks already developed their credit scorecard or rating model. So what's differentiate between the credit scorecard or rating with the EWS? So maybe let's put it into this way. We already have a loan application, for example, to the bank, and then they decide our credit worthiness, right? From our characteristic, maybe demographic, what is our job, what is our salary. If we are talking about the person, maybe we are talking about a small company, for example, like how much income coming every month and what is your expense, things like that. We want to see how their profit and loss, and we want to see how much the volume of the transaction in the debit and the credit. And then we decide whether we want to grant the application to this debtor or not. That's showing like we can see the credit worthiness of this debtor, like what is the probability of default of this debtor, but we cannot see in the future, right? this EWS currently is combining both internal and external data. So it's not only taking into account your transaction data or your financial statement, but it also taking into account the external condition, for example, like the macroeconomics. So this model currently not only looking into the debtor perspective only, but also the external perspective. Like, for example, we probably having some crisis or maybe in the midst of inflation rises, things like that. It can also take into account into this EWS model. So in terms of the predictiveness, it's probably better than the credit scorecard, the usual credit scorecard or credit rating. And also the ability of this EWS model, it's also can predict whether in the next few months, this debtor will decrease in the credit quality, things like that. So it's quite giving new insights to the risk management, I would say.
Okay, thanks, Mel. I think it is something interesting points because credit models is being utilized by banks, by mature banks, to look into the future, right? So it's not just what is the rating, what is the score at this time, but what will be the rating, what will be the scoring 3 years from now, or 1 year from now, or 5 years from now. Now, when you look into something like that with a long period of time, how accurate is that? I mean, based on our experience, can you explain, is it 90% accurate or 70% accurate? Because it is, I would say, something that is not commonly done in the last 10 years, probably.
Yeah, I would suppose like if you are talking about the EWS, since it's incorporating a lot of data, right? A lot of data types from the customer itself, demographic, and also the financial statement, taking into account of the transaction also. I would say the accuracy ratio from the my experience is more or less 70% up. If you are talking about the usual credit rating or credit scoring, usually it's only like around 40% accuracy. So in terms of this EWS, even if you're looking at the longer term, it still can accurately predict because of that robust data points that we use in the developing the credit model itself.
Thanks, Mel. So if I can summarize what the banks are doing, the mature banks are doing at this time, based on the newer credit models, is that they utilize transaction data. I think this is because most of the financial data is only on annual basis or quarterly basis. So I think transaction data can do it in a more frequent basis. And the second thing is what we call as EWS, which is combining the internal data and also external data. This is the macroeconomics data.
Yeah, true.
And also probably in the stock market and all of that.
Yeah, it can, I mean, like currently we only limited onto the customer data, the demographic, and also the financial statement, and currently the macroeconomics. But again, I mean, like there are a lot of data that we can explore. For example, we can even use the e-commerce data or even the e-wallet data, telco score. It all can be incorporated into the credit model.
So basically, even banks are looking into new data, new alternatives data, to find out whether the person or the company can pay and willing to pay. I think there's a like a red line between all the fintechs and digital banks and mature banks, in that they would like to keep on improving their credit models. It is for the predictive power and also for determining who is the right person I can give my money to. Okay, thanks, Mel. I think there's one more interesting aspect that I think this is something that you also said on the use of AI, right? AI is a big thing. Like, just put AI in your company's name and probably you'll make a lot of money. Now, I would like, in the past it's crypto, right? Crypto this, crypto that. Now AI this, AI that. So what I would like to know is that what is the impact of AI, especially in the credit models? Because EWS is using a system, right? So basically, it's just this short-term way from system into AI, right? So I think I would like to ask our panelists about the hot topic, AI, right? How do you think AI can really help the credit models to adapt to global uncertainties? Or perhaps AI is doing something simpler? It's like making all the analysts watching Netflix on the job and let AI do all of those things. Okay, maybe I'll ask Michael first. What do you think about it?
So I think it's an interesting question, right? I mean, if it's really can help us watching Netflix, I'll welcome it. Of course, will make my life easier, of course, right? But I think the reality is not as good as that, unfortunately, right? So, okay, again, this is speaking from experience, right? I mean, in the fintech space, there's a lot of dynamics happen, right? I would say, because fintech mostly usually online. So we are attracting customers from a very diverse profile. You can have anybody download the app and then just apply, right? Compared to the traditional way of doing an underwriting or applications, you go to a certain shopping malls and then you source people who come to that malls, which usually limited to a certain profile, right? If you go to the high-end malls, then most probably you'll get the high-end profiles. So with this kind of things and changing market conditions, there is almost impossible for a traditional way of doing modeling and analysis to keep up with the change, at least in the fintech space, right? Except maybe if you are doing a very specific sourcing to a certain partners, maybe the challenge is not as big, but it is big nevertheless, right? So this kind of things can be taken by an AI because the analysis, because you only have, I mean, going to the practical data thing, you only have, let's say, a certain customer profile with a different profile compared to the rest of your portfolio, but it just come with a very limited set of data, right? Meaning that there might be people interested in your product, but it's just that they are just start coming to apply for the loan from your side. So if we do it traditionally, it will be very hard to spot there's a profile change. But if you employ machine learning AI, then it can be more apparent because they can process multiple data points, right? That they can spot something is going on or something is not as per the average here, right? But again, it's always a check of mix and balance, I would say, because in order for this model to perform, then it follows the principles that if you have more data points, then it will perform better, right? Usually relevant data points. But practically, economically, you have more data points, then you have more costs because you have to engage multiple vendors, you have to keep the data, you have to whatever, right? So it's always be, I would say, check and balance. And I think we are at the just beginning of this journey, that whether AI can replace the job or whether AI can complement the job, I think it's still a question to be answered. But I'm more leaning towards that based on what we do currently, it's actually starting to complement with each other, at least in doing the job of managing risk.
Thanks, Michael. I think from what you said, I think you made some interesting points, which is it is quite difficult, especially in fintech, right? When the population's profile keeps on changing, if you have to do it manually, it'll be might be some lags in the profile changes, and it is not really efficient to do that. But I think what Michael said is that AI essentially can help on the high frequencies but less complex works. You still need to start with something. So this is probably what AI is capable of doing right now. So it is very helpful in fintech.
Yes,
Pak Michael. Okay. Thank you, Pak Michael. I would like to hear from Joseph, another perspective. So in terms of digital bank, right, the credit decisioning is probably not automated. Some has to pass some credit decisioning. And what do you think of the role of AI can help you in helping the credit decision? Because actually, Indra and I, we had a bit of research funds. We look at ChatGPT and we ask, what is the credit score of one of the companies in Indonesia? Actually, they says, I don't know. Actually, if they can say yes, then I don't know what I'm doing for the next 10 years. But thankfully, ChatGPT still say they don't know. So, Pak Michael,
Yeah,
sorry, Pak Joseph, can you help us enlighten us?
Yeah, I think AI is a hot topic right currently, and it's quite new. So I actually agree with what Pak Michael said earlier. Currently, AI is sort of like complementing the things that we do, maybe helping in some sort, maybe acting as an assistance. And actually, one interesting point is AI is really good at detecting patterns, right? They can actually understand, even if we don't talk about the credit modeling use case, they can actually understand your sentence. If you put slang words, if you don't use any proper vocab and grammar, they could understand that. So one use case maybe to in credit risk, and there could be a lot of use cases like this. Basically, if you have something like, for example, like the high frequency use case, is actually a good use case. So things like the transaction analysis or the bank statement analysis, right? I think from different banks have different formats, and traditionally, you want to build when you want to build credit models from using this transaction or statements, you need to categorize the transaction, right? Like, is this like spending on food? Is this like cash flow that is income, your payroll coming in? But payroll from different companies, from different banks has different, I would say, like characteristics and wordings in the bank statement itself, right? And actually, we last time in the office, along with the ecosystem group, we had a hackathon, and actually Superbank did try this one use case, and AI could actually predict these patterns pretty well. So for example, Starbucks, sometimes it's written as STRBUCKS without the A, or maybe like in some bank statements, because it's too long, it's being cut off at the end. But AI could actually detect that Starbucks is actually like Starbucks is the company Starbucks, and then it's a food and beverages category. So prior to AI, right, doing all this, you need to do like manual mapping, a lot of those, because if you list like all of the restaurants in Indonesia, or even like how can you do that manually, right? And then to be able to categorize these things into like the right category, whether it's grocery, whether it's like high-end goods, whether it's a subscription, whether it's like a one-time purchase, it's essentially a really painful task. And with AI, you can actually try at home with your generic ChatGPT. If you don't mind sharing your, of course, bank statement data to ChatGPT, that's another story. But I've tried, like the team actually, we have tried uploading something like this, and actually we could get a pretty good result. We could, for example, let's say I spend, I don't know, 5 million in a month, then they could actually help me categorize, oh, 1 million is for food, 2 million is for this, your income is 3 million or something like that. So this is one way AI could actually help us in the credit modeling space, because then what you can do is from all of this, right, it could become features, like the category could become features, and those features you can fit into your model, because I think there is some sort of maybe like loose correlation with probably like income or whatnot, right? For example, if I'm spending 5 million a month on food, I must have an income category of this much maybe. And if I am spending, I don't know, like maybe 2 million on entertainment or cinema, then that sort of behavior, AI could actually help detect those kind of patterns. But at this point, it's only like generating new features for your credit models. It's not entirely replacing the credit models. So I guess this is one of the use cases. And actually, even before this session, I was looking through the web, but I don't see any AI that has been successfully, like real AI, used in credit modeling, like to replace the machine learning or even the scorecard way of doing the modeling yet. But again, as Pak Michael mentioned, this is still new. Everyone is still learning, and AI is still developing exponentially. So we don't know. In the future, it might change.
Thanks, Joseph. So in terms of the use case of AI in digital bank, it can be used, for example, to automate some processes, right? So maybe for all of you who work in banks or having to do manual works is basically AI can help you to do the copy and paste for you. Because from my experience, I think most of the job and is not exactly analyzing, but doing copy and paste. And I think AI can help you with that, right? And what you said was interesting because AI is not used to generate new features in the credit models, but only to support the existing model, right?
I think it could be used to generate new features, but what I was trying to say is it's not replacing the
not
credit
replacing.
model yet.
So it is more like adding new patterns.
Yeah, it's like
but
helping us build the credit model. I would
you need
say.
to start with a proper model, then AI can help you to refine that, right?
Correct. Yes.
Okay. Thanks, Joseph. So I think the last one to Melody, I think this is the problem because we heard like AI can do this, AI can do that, but there's an issue of agency when it comes to decision. Because what is automated is not a decision, basically, it's an algorithm. When it comes to the decision, sometimes you need an agency, which means a person who decides yes or no. And the role in the past coming from a risk analyst or risk officers or CRO. So with the growth of AI, what do you think will be the roles of risk or finance professional in the future? Will basically what I'm asking, are we still going to do our jobs? Or is it going to do our job for us now?
Okay, thank you, Aldri. So basically, I think at this rate, AI will not replace our job, so we can all be a little bit feel safe. But again, as Joseph say, AI is currently developing exponentially. So in the future, I'm not sure. But I suppose currently AI is supplementing the risk analyst or the risk officer to make a decision regarding our credit worthiness. What I'm saying is basically, maybe Joseph already talking about the bank statement analysis, for example. We also use the bank statement analysis currently. We built some model to help us check whether the small medium enterprise has a window dressing currently or it's a really transaction happening over there. And I suppose it was performed manually by each of the officer in the in the bank, basically to deduct and see whether this is a real transaction or not, is this a window dressing or not, and then the net amount of the bank statement analysis. And also each of the bank has their own format, so that's a challenge also. As we might know, if we have a lot of human intervention, probably there's some error also in the data. So what we are trying to reduce is basically the error in the data input for the bank statement. So currently, like the AI can help us perform that task automatically. So it will help the risk analyst or the risk officer to get more accurate data. And also it will help in the decision making currently. Yeah, I suppose that answer your question, Aldri.
Okay, thanks, Mel. So I think from Melody's perspective, is still AI at this time, still not clear what are their capabilities in the future. But right this time, they're more of supporting the role of risk officers or the roles of finance professionals. I think there's a point on the agency. Sometimes what we need is someone who takes responsibilities, right, Mel? I'm not sure if FI wants to take responsibilities if something goes bad. I mean, who's saying, who make this decision? AI probably is not going to do well with the board of directors. What do you think about it now? Does it work that way? Does the agency issues is something that is that might not be solved by AI? You still need someone to make decisions, because actually in the business world, someone needs to take responsibility, right? Which something that probably AI cannot do. So do you have any comment on that?
Yeah, I suppose again, AI currently is only complementing on the decision making. So it's not making the decision for us, but the human itself, the risk analyst, the risk officer still needs to take responsibility on performing the decision. But what AI can do, can support, is basically giving some more accurate information, and also maybe more accurate, and also the speed of the AI works more better than the human itself, so more accurate with the speed also. And I suppose, yeah, we still need to perform manually on the decision making, but AI will support us better in performing the decision making itself.
Okay, thanks, Mel. I will recap a little bit before I will ask some questions through the floor. I think from the perspective of fintech, digital bank, and bank perspective, credit models are something that is being used on a daily basis, and the lack of data doesn't mean that you cannot create credit models. I think from Joseph, he said like you can look at alternative data. I think if you're corporate, you can also, if you want to create a model on your receivables, for example, you can also use the alternative data. It doesn't have to be credit data. I think from Michael's perspective as well, is the use of data in fintech is quite a lot. And it is interesting how patterns change can actually inform you what is changing, what are the frauds, what are the issues that you have in your portfolio. From Mel's perspective, models are not just used to reflect what is the current condition, but it can also use to predict what will be happening in the future. With the use of EWS, early warning system, you can look at the future with a decent amount, or well, not decent, but with quite a good amount of accuracy, 70%. And from the perspective of AI, we still don't know at this time how far they can go. I think, but right now it's more of supporting role. And I think the role of risk and finance professionals are still safe at this time, because someone still wants our head, right? If something goes wrong. Okay, I think that's the recap from the discussion, and I would like to check the floors if you have any questions. Okay, please go ahead, sir. Yep. Okay. And the ones in the back first, then go see. Yang di belakang, sorry. Can you mention your name and your question, please?
Yep. Hello, my name is Aryo from Heyoka. I would like to ask a question to Joseph, probably, or anyone could actually add things, I guess. But I would imagine that, you know, if you're a primary bank, meaning that bank is used as a bank to compile all the incomes, where your main income stream is going through that bank, then it would be way easier to actually predict credit scoring. But as a secondary bank, if that's even the right terms, not knowing the income stream of the main income stream of a client, how much disadvantage does this actually impose to the credit scoring system? I guess, like, you know, if I were like to change the question, it would be like, how much percentage is the primary banks, which I think would be like, I say the top 4 or 5 banks, be in an advantage as compared to other secondary banks? I would think like digital banks would rather be on that kind of segment. And secondly, I think, assuming that it does have a significant role, what is the top 3 predictor of default, or like for credit scoring for secondary banks, other than you know, obviously if we can't get the income, the salary, then what is the top other 3 indicators, or like metrics that you can actually use in order to be on par with those banks who have this data set, I would say?
Okay, I'll try to answer the first one. I think you are correct that in a way, if we don't have, like, if we are not a primary bank, or if the income does not go to the account that we manage, then it's hard to guess the customer's income, right? And it's actually quite important, because one of the goal of the credit underwriting is actually to determine the credit limit, right? How much could we give you? Because of course we will ask like your salary and things like that, but if you are only like writing 50 million, 30 million, how can we validate, right? And it's not often that customer wants to share their bank statement that has their real income or even like their tax statement. So what we can do is actually, of course, we are at a slight disadvantage, but actually we could build like this sort of proxy income by using, by using like their transactions data, like in e-commerce, in other platforms that maybe we have access to, in ride hailing, in e-wallet or something like that. It will not be income, but it's a proxy income. And even without this, there are currently like vendors, even like the telco vendors, like some of them actually offers income estimation. So the income will not be accurate, like say 10 million, but they offer estimation in the form of a range. So this type of vendors, we could actually use also to determine the income. But I guess, yeah, in a way, like during underwriting, this income is actually very, very important. Like you need to be able to know their capacity to pay, basically, in order to determine like the correct credit limit. But there are ways to do that even when you don't have the user real verified income, I would say. Yeah, and then maybe before we go to the second question, maybe Pak Michael or Bu Melody, you guys want to add? I'm sure fintech has a lot of experience in this as well.
Okay. So on the income, I think it's always classical question, right? When we underwrite somebody, that can you provide your proof of income? And when they provide it, we usually second guessing, is this the real one or not, right? Usually forgery is there, right? They are upping their incomes. So there's a lot of proxy, just like Pak Yosef saying that the proxy income or derivation of income usually is the favorite way to do it if we don't have the real data, right? So the e-commerce transactions, if you have access to that data, will be very good. Or let's say if you have access to, let's say, travel data of the person, usually a person is spending a certain percentage of their income to travel, right, on yearly basis. So we can derive also the income from that. And there's also usually in fintech, what we do is that since we are serving the underbanks, then we know that their income most probably will be below 10, right? Or maybe below 8, right? That's most probable. And depending on the profession that they have, usually we are starting small on the first loan, right? So give it a small loan, see in the shorter terms whether they can pay. It's not 1 month, because 1 month might not give you a correct predictor of the sustainability of payment. Usually, let's say 3 months, you give not so big of a loan, they can pay good, right? And then the second loan, you are trying to increase the limit by a certain percentage, let's say 25%, 30%, and then see how much fall off of that segment, right? Usually after 2 or 3 loans, if they are able to pay consistently without anything overdue, if there's no big events, usually you can be safe to say that their income at minimum is at that level, right? So there's also a way that we can try to leverage how we derive the income from that.
Yeah, a quick one from Mel. I think this one is from retail perspective. Do you have any opinion, probably from corporate or SME?
Yeah, I suppose we have leverage here, since usually the bank can ask you to provide the bank statement from the other bank. We can leverage from that. And yeah, I suppose in terms of defining like how much your income, again, maybe this bank statement play a bigger part, because I mean, like, we can always window dress our transaction, right, to make our income seems bigger than it should. But again, with the help of AI, probably we can give the netting from what your income should be, rather than the window dressing part.
Okay, thanks, Mel. Maybe a quick one from Joseph on the second question. Oh yeah, I think in terms of the predictors, unfortunately, like the strongest predictor is usually like your credit bureau history data. Like if you have that, like your payment on time payment data, repayment data, that is usually like the strongest. But then transactions in the other platforms actually come close on the probably like second or third place. The rest is basically like your behavior data. Yeah, I would say that is usually the top three.
Okay, thanks, Joseph. I hope that answers your question. Okay, next one.
Thank you.
But maybe the Bapak yang di depan. Okay, you have a question.
Okay, thank you.
Yeah.
Okay, my name is Lugas. I'm from BNI Ventures, and perhaps because the first question is too serious, perhaps I want to ask something that is more lighter, but more I think it's higher level question. I think you guys will also mention that AI and also the has given us an edge on modeling on how we manage the risk, credit risk, in particular that we discuss. One aspect that I want to ask is about that. Other than lighter human touch, how do you guys really manage your model risk? Because I think we will become more reliant to our models, right? Or how we train all the data. But as we know, the world's getting more complicated, the data getting more unstructured and so on. So how do you really manage that something has changed, something that haven't incorporated into your model, or basically your model risk? I think I would start with that. Thank you.
I think if I can summarize your question, how do you manage your model? How do you manage your models, right? How you manage your risk models? I think maybe to Mel first.
Yeah, okay. So if we're talking about the wholesale banking and then how we manage the model, bank currently are exploring on the model risk management. So this is like a platform when we can put all of the models that are currently available in the bank. And then also the validation that needs to be performed periodically. And it's being maintained in this framework of the MRM itself. So it will help the bank to see if they already capture all of the risks that available in their current model, or whether they need to add more or develop more credit model to support maybe their business or their marketing, things like that. But I suppose having this one platform to support all of the model validation from the model development, from the integration of the model itself, it will help the bank to see the bigger picture of the risk management for the bank itself. I suppose that's from my end, maybe from Joseph or Michael.
I think I can add a little bit. I think still the usual way of, I guess the normal way of looking at the model life cycle still applies. So we have validation, and then throughout the life cycle of the model, we also use a few metrics to monitor the model, right? To see whether like the distribution has changed, the performance has deteriorated or not. So things like this, I think still applies, I would say. So even like, for example, if we dabble with AI, right? We will not, let's say we can create a model using AI. We will not actually launch the model without like the proper guardrails in place, right? Maybe combined with the credit policy as well. And also the way usually like we, I guess as data scientists, we launch model is usually we test the model first on a smaller subset of users or smaller segments and see if it works well, then we scale it out slowly. Hence that way, there is still a risk, but the risk is minimized or more limited, I would say.
I think it's very interesting question. But again, I think how I answer it is going back to the basic principles, right? But so I mean, the model, the concept of model itself is not something new, right? But how we build model with machine learning, AI, and the market condition change is totally different compared to what we used to do traditionally. Logistics regressions, now there's random forest and everything, right? And then XGBoost and everything. But I think the basic principle still holds. So I think there are a few things that usually comes to mind. One is that when we have a model, it is built very specifically for a certain purpose, right? I think what usually the pitfalls is once the credit modelers build it, the business guy is using it for everything, right? So it's built for certain purpose. Now it's used for everything, right? That's where the model will fall short. And then they will come back why your model doesn't work, right? So then it's always a classical questions, right? So I think it's important that when we build a model, it needs to be very clear on what purpose, what are the target markets, and what will be the appetite or expected outcome when the model is being built, right? So when there's a new business or when there's a new validations, then it is important to always adhere to the original purpose of why the model and how the model is built. Then that things need to have a discipline. I think monthly, quarterly, or whatever is needed, then it needs to follow the basic same principles, right? That will be the first part. The second part, I think, which is not equally not important, which is equally important, is that we'll need to be able to validate our data. It follows the principle of garbage in, garbage out, right? Because when the model is built, usually using machine learning or AI, there's thousands data points that it is consumed, right? Then it usually come up with the 20 or 30 of the determinant variables. Now, these variables, we just need to be sure that it's not easily manipulated, right? So if it is something that is declared, let's say, then it is very easy to be manipulated, right? But if it is a bureau data, it's still possible, but it might be very hard to manipulate, except if you are having very specific person that is trying to build credit history and then suddenly they want to cash out and gone, right? But that's usually a very small case, right? So I think data validation is also important, and how we validate this data is, I think, something that is usually still evolving because more data is consumed.
Okay, thanks, Michael. Thank you for sounding all the concerns of risk modelers in the world. Okay, I hope that answered your question, but and I only have probably time for just one more question. Can you have a quick one? Maybe for those who have another question, you can contact all of us during the. No, I think Pak itu dulu. Yeah, I think that's this one. Yeah, but I'll talk to you separately after during the dinner, right?
Okay, thank you. Okay. My name is Restu and I come from telco company, Telkom Indonesia.
Okay.
Okay. I have two simple questions actually. The first one is, as per I know, the customer segment or customer profile of fintech or digital bank currently is including, sorry to say, maybe we can say like not the big fish one, because big fish maybe still in the conventional bank.
Okay.
So in a more business term or in the technical level, we talk about the credit worthiness, credit scoring, but in the business level, operational level, is there any contradiction or like a dispute when you make a decision, a business decision? For example, like as we know, like we can say that the customer of digital bank and fintech in Indonesia is the one maybe get difficulties in getting a loan or credit from the conventional bank. So how essential is you making a really good model of credit worthiness, credit scoring, if in the business level of decision making, there's a dispute or contradiction. For example, if the credit worthiness is, for one customer, if the credit scoring is low, but for business, how company will make profit if you really selective in making a customer profile? And then the second question maybe for Jacob, because we have the data for the mobile data consumption. So I want really know, or maybe you can explain in a brief about the model. For example, like how many is the weight for example, the mobile data consumption from your model to determine the credit scoring? Maybe you can say like 20% from the model, or what is the other 75%, for example, to determine the credit scoring? Okay, thank you.
So yeah, thank you. But I'll try to summarize and probably just give a quick answer, probably just 2 minutes. The first question is about the opposition between business and risk, and how do you as a risk officer or risk analyst is handling that? Well, that is probably 80% of the stress in risk management, right? So the second question, I think I'll give to Joseph on the percentage of telecommunication data usage. Considering the time, probably just give 2 minutes each.
Okay, so I think dispute will always be happening in a healthy business, right? If the risk guy and business guy goes along 100%, I very doubtful. They don't work, right? So I think it goes back to that basic principle of model development. At the usually when we build a model, there's a purpose, there's a goal, right? Usually it is to determine good and bad, right? Which is the bad usually is the loss, okay? But after that model development cycle, there's usually an additional step, which is what we are doing is that we are trying to see if we determine the cutoff of that score, how it will impact the revenue, right? Which might not goes along linearly with the loss, right? So I'm taking example of a certain very good portfolio, let's say risk level A. It is very good, 0 point something percent loss, but the revenue is so small, right? Because there's only the pricing is very low, that's attract that kind of customers, right? So that normalization, I think, will come to the sweet spot on what will be the loss and what will be the revenue that can pay for the loss. It goes back to that question of how the risk appetite is being set. I would say that's usually how it goes between risk and business, how to resolve the dispute.
Okay, so the answer is how you determine the risk appetite in the model development. I think the next question, Joseph.
On the second question, I actually probably don't have a very good answer for this, because currently, due to like some regulation and things related to regulation, I think most of the telco companies actually do not share the raw features itself. Meaning like the features that you mentioned, like data consumption, for example, it's they mentioned that they did use that, but if we the output that we receive is not like for example, for Joseph, do I spend 1 gigabytes each month or something like that? But it's more like Joseph has a score of 700. But to build this 700, they actually do share the list of variables, and data consumption is one. And then the other one is like habitual variables, like how often do you open like e-commerce sites? How often do you open your mobile banking or lending sites, or even like travel websites? And then another one is basically like the monetary variables, like the pulsa that you buy, the data package that you buy. But other than that, the data variables that you mentioned actually falls under usage. So they actually look at like phone calls, WhatsApp, SMS, not the content, but more on like usage, what time, how many, and things like that. Yeah.
Okay. So yeah, thank you for questions. I think we have a lot of questions coming in. So, we'll kind of talk about it later during the dinner after this. So thank you so much for the enthusiasm. There's a lot of questions. There's a lot of interactive activities. But I think that's all the time that we have for this panel discussion. So I would like to thank all the panelists. Let's give them a round of applause for all the panelists. And I think I will hand it back over the session to Mark.
Thank you. I'd like to invite Mr. Indra Lucas Tahaja up to the stage to present a token of appreciation. Okay, and just whilst this is happening, following this short presentation, I'd also like to invite up our earlier speakers, Mr. Wong and Tommy, if you could come up after this one, and also Melissa as well. We'll take another group photo today. Okay, so last thank you for Aldrich and our panel for that great discussion. Thank you. Melissa, sorry, just stay on the stage. And if I can invite Mr. Wong, Mr. Zhu, and Melissa up onto the stage. Pak Rahmat. Great, thank you, everyone. Okay, so today we've heard from Melissa earlier about the vibrancy, the opportunities, the challenges here in Indonesia that we're facing at the moment, and then from Mr. Wong we heard about the psychology of the markets and how things like greed and fear and confidence can change asset prices over time. And I think also something that I'll definitely be taking away from this is the relationship between commodities, inflation, and then interest rates from Mr. Wong's presentation. Tommy gave a great talk about dollar cost averaging, volatility and hedging outliers and diversification. And then we had the credit scoring panel here from Aldrich, where we went through, fraud, the effects of COVID, how businesses deal with COVID, the use of AI and how it's only being a supplement at the moment, and ways to derive income as well, ways banks use to derive income without actually having a pay slip. So I think it's been a great session today. And so I'd like to firstly thank our organizers, mainly Pak Rahmat and Bu Dewi. Thank you very much and all of our volunteers for today who make this possible in the background. Thank you very much to our partners, CME Group and GARP Indonesia. Without our partners, we can't make great events like this. Also like to thank obviously all of our speakers and panelists, and thank you everyone for joining. For the CFA charter holders, our next event will be, I think, the following Friday for the 22nd of September for our annual general meeting. So please come along. And I think with that, I will close the conference and invite you all outside for a networking dinner. So I think dinner is ready. And so let's not let it get too cold. So thank you very much, everybody. And I'll see you at the next event.